when companies are preparing a statement of cash flows, the various activities undertaken by such a company or by such companies should be classified into three categories. So, mean that for the purpose of preparing the statement of cash flows, then we classify the activities of a company into three. Number one, we have the operating activities. Number two, we have the investing activities. And number three, we have what? We have the financing activities. First of all, what do you mean by the operating activities? Operating activities, these are the revenue generating activities undertaken by a company. Revenue generating activities undertaken by a company. Like basically here at Focus Online College, we offer some training of various custom courses. So that is our revenue generating what? Activity. So therefore, these are the revenue generating activities undertaken by the company. They include provision of services. They include sales of goods. Investing activities are those particular activities which involve acquisition and also disposal of assets. Any activity involving acquiring and also disposing or selling assets is an investing activity. And finally, financing activities are those particular activities which by the end of the day affect the size and composition of the company's capital structure. These are activities which relate to issue of shares, issue of debt instruments like debentures, acquisition of bank loan, repayment of bank loan, and maybe redemption of things like what? Debentures. So therefore, when preparing a statement of cash flows, basically we classify the activities into those three categories. And then from there, we must compute something called the net cash flows from each of these three activities. We must determine the net cash flows from operating, investing, and financing. How do we determine these net cash flows? Net cash flows from these three activities. We take the cash inflows, and basically cash inflows, this refers to any cash which is coming into the business, any cash received by the business. And the rule is that when preparing the statement of cash flows, any amount which is a cash inflow, we record it as a positive. Any amount which is a cash inflow, we record it as what? As a positive. A good example, if the company issues share, if the company issue debentures, if the company sell an asset, all those transactions result to cash inflow. So the cash received, we record it here as a positive. And then to this, we less the cash outflows. Cash outflows, basically, this refers to any amount of cash which is flowing out of the business. So like whenever the company purchase an asset, when the company, for example, redeem shares or even debentures, that give rise to cash what? Outflow. The rule is that any amount which is a cash outflow, when recording it in the statement of cash flow, we record it as what? As a negative. This is very important. A cash inflow, record it as a positive. A cash outflow, record it as what? As a negative. So that means that at each of these activities will be taking the cash inflows as positives and cash outflows as negatives. Then you add all those cash inflows and outflows, you get a net what? Net cash flow from each of these activities here. Now, before we look on how we prepare a statement of cash flows, it is important for us, maybe first of all, we define some few terms. Let's look on definition of various terms. Definition of various terms. These are basically terms we will come across when preparing the statement of cash flows. So the first term here is cash. What do you mean by cash? Cash, basically, this comprises of cash in hand. This also comprises of cash at bank, and also this comprises of something called the demand deposit. So when talk about the demand deposit, usually this refers to any amount of money which is held in a fixed deposit account. So if a company is operating a fixed deposit account, any money which is deposited in that account, we refer to it as demand deposit. For the company to be able to access that amount of money, the company needs to notify, to give a notice to the bank. The company can only be able to access that amount of money maybe after 2 or 3 working this is the demand deposit. So cash comprises of all this. We have the other term, which is a cash equivalent, equivalent. And basically cash equivalent, this refers to the short-term investment, which can be converted into known amount of cash within a short period of time. So therefore, these are short-term investment, which can be converted into known amount of cash within what? Within a short period of time. Within a short period of time. A good example of this is where, for example, a company has invested in shares which are trading in the securities exchange market. That is basically what? A cash equivalent. If, for example, today, maybe you own some shares, and those shares basically trade in the securities exchange market, that is not cash to you, but basically cash equivalent. Because if you need money maybe by the end of the week, what you just do is you inform your stockbroker to sell those shares, and maybe by Thursday, Friday, you should pay to creditors or suppliers the cash outflow, cash paid for operating expenses, cash outflow. Then we have these two items which we consider here: tax paid, the interest paid. Those are cash outflows. That's why you can see we are considering them here as what? As negative. So then from there, how do we determine the same? How do we determine this net cash flow from operating activities? Using the other method, the indirect method. The indirect method. Indirect method. Now, under this method, we compute the net cash flow from operating activities by adjusting the operating profit with the various items, three category of items. So here, under this method here, to compute the cash flow from operating activities, we start with the operating profit. We start with the operating profit here. We start with the operating profit. Basically, the operating profit, if you can be able to recall, in the topic of ratios, we said is the same with the profit before interest and tax. But in most of the questions, the examiner will not have given you this, the profit before interest and tax. So what the examiner will have given you is the profit before tax. Basically, what you start with here, you start with the profit before tax. And for you to have this, the first adjustment which you make to this profit, the first adjustment is basically to add back interest. To add back interest. And if you can be able to recall interest, this is also known as the finance cost. So the reason why we add that back to this profit is for us to have the profit before interest and tax, which is also known as the operating profit. Now, this operating profit, we adjust it with three categories of items. One, we adjust this with the non-cash items, which were added or basically deducted in arriving at that profit. So which are those non-cash items? Remember, there is a certain acronym which I've given you somewhere here, which is basically 𝐷𝐿G. 𝐷𝐿G. So 𝐷𝐿G basically I've said this stands for depreciation, I for impairment loss on goodwill, A amortization of intangible assets, L loss on disposal, G gain on disposal. So those non-cash items which were deducted in arriving at this profit, like depreciation, impairment, amortization, and loss, all those items in arriving at that profit, they were deducted. And because they are non-cash items, what we do, we add it back. But the gain on disposal is an income. In arriving at this, it was added. And because it's a non-cash item, what we do, we less it. So first of all, we adjust our profit with that. Number two, we also adjust it with the changes in working capital. Working capital here, equally there is an acronym which we use here to recall the various working capital items we consider here. And the acronym is RIP, not less in peace, but RIP, receivables, inventory, and payables. Receivables, inventory, and payables. So in this case, you just need to consider, was there an increase or a decrease? Compare the opening balance with the closing balance, see whether there was an increase or decrease. So then finally, we also adjust this particular profit here with the investing and the financing activities items which were added or deducted in arriving at this what? A profit. Good examples of these investing activities may include investment income. Investment income in arriving at this profit, or actually this profit include investment income. But we know investment income, this is an income generated by the company from investing. It's not an income generated by the company from operating activities, from operation. So, and because that investment income is included here, we less it. We less it. And then when computing the cash flow from investing activities, then when we consider that amount. So therefore, any investing activity, any investing or financing activity item added here, we less it. Any investing or financing activity item basically added here, we do what? We less it. And those basically which were deducted in arriving at this, we do what? We add them back. We add them back. We get the net amount here. And basically, finally, here we less the tax paid. We less the tax paid simply because it's a cash outflow. And then the interest which was paid. The interest which was paid. Basically, what we get here is the net cash flows from operating activities. The net cash flow from operating activities. Now, this is basically the difference between these two methods, how to determine the net cash flow from operating activities. But now, once we have computed this cash flow from operating activities, we must proceed and compute the cash flow from investing activities and the cash flow from financing activities. To compute those two components, the cash flow from investing, the cash flow from financing, we use the same approach as the two methods. So basically, after we have computed this, we proceed and we determine or we compute the cash flows from investing activities. Remember, in this case, you just need to recall that investing activities, these are those activities which involve acquisition of asset and disposal of asset. So here what we consider are basically the assets which were acquired by the company during the current year and those assets which were disposed. So here we consider acquisition of assets. Acquisition of asset, basically this one involves cash outflow. If you buy an asset, that gives rise to cash outflow. We also consider the disposal of assets. Disposal is the same with the sale of assets. And then here we also consider any investment income received. Those are the only items which we consider here. We get the net amount, we take it to the last column, and finally we determine the cash flows from the financing activities. Financing activities, or basically all the items which we include here in computing this cash flow, we get them from equity section in the balance sheet or in the statement of financial position, and also the non-current liability section. That's where we get all the items to be included here. Go to the statement of financial position, and equity, and non-current liabilities. That's where you get the items to be included here. Yes, disposal of assets. Yes, disposal of assets. Sorry, this one should be positive because once we sell an asset, we receive money. Money received is a cash inflow. Investment income, we receive money, is a cash inflow. We buy an asset, is cash outflow, should be recorded as a negative. So what we consider here are items such as issue of shares or maybe issue of debentures. We also consider acquisition of loans, acquisition of bank loan, acquisition of bank loan. We also consider the repayment of bank loan, the repayment of bank loan. We also consider things like the redemption of things like debentures, and also we consider payment of dividends which were paid. Now, once the company issues shares or debentures, that result to cash inflow. Once the company acquire a bank loan, that is a cash inflow. Once a company repay a bank loan, that is a cash outflow. Once the company redeem the debentures, that involve cash outflow. Once the company pay dividends, that involve cash what? Outflow. So we get the net amount, we take it to the last column. And then from there, we get something called the net changes in cash and cash equivalent. So how do we get this? So to get the net changes in cash and cash equivalent, we take this one, net cash flow from operating activities, plus this, net cash flow from investing activities, and this, net cash flow from financing. So we take A plus B plus what? Plus C. Whatever is a negative, you take it as a negative. Whatever is a positive, you take it as what? As a positive. And now to this particular amount here, this one, we add something called the cash and cash equivalents. We add something called the cash and cash equivalents. Cash and cash equivalents. Balance brought down. And in this case, you have to recall what is cash. Cash comprises of cash in hard cash at bank, and also the short-term investment, including the bank of overdraft. That's basically what we consider here. Cash in hard cash at bank, short-term investment, including bank overdraft. Basically, we add it to this amount here, and we get something called the cash and cash equivalent balance carried down. Balance carried down. So this is basically how we present, or in other terms, this is how we prepare what is known as a statement of cash flows. A statement of cash flows. Sawa? Is that well understood? Is that well understood? How we prepare statement of cash flows? Is that well understood? So, but basically, you can only be able to understand this once we do maybe one or two illustrations. Yes. So I want us to just take a small breather of how many minutes? 5 minutes. And then as we come back, I want us to look on a question. From a past paper. And I want us to do a question for last sitting. There was a question. Actually, this is a very common area, but I want us to just start with a question which we will be able to finish within the next 1 hour. So let's start with this one. December 2022, question 5. So as we come back after that small breather of 5 minutes, make sure you have that question with you. December 2022, question 5, a question for a company called Maram Limited. So see you after that short break. 5 minutes only. We come back at 8:52. Yes, we proceed. We proceed. I hope you already have the question with you. The question is for December 2022. December 2022, which is question number 5. Question number 5. We should finish this particular question here, such that once we meet in our next class, we basically do another one. So we are told the following draft financial statement were extracted from the financial statement of or financial records of 𝐼𝐍 Limited, a public limited entity, as at 30th of April 2022, with the comparative for the year which ended 30th of April 2021. So in that case, we're given the statement of financial position for 2 years, 2021 and 2022. Down there we have the statement of profit or loss, another comprehensive income for the year which ended 30th of April 2022. We have additional information, number 1 all the way to note number 5. What are we required to do here? We are required to prepare the statement of cash flows for 𝐼𝐍 Limited for the year which ended 30th of April 2022 using the indirect method in accordance with the International Accounting Standard number 7 statement of cash flows. Now, before you prepare that statement of cash flows, it's always advisable, first of all, go through the additional information you see. Is there any working which is required? You do those workings, and then you prepare the statement of cash flow as required by the examiner. So I want us to go through the additional information. Basically, we see whether there are some workings we need to do. And then finally, we prepare a statement of cash flows. In additional information about you're told, 𝐼𝐍 Limited acquired a new plant, or basically purchased a new plant during the year which ended 30th of April 2022 at a cost of 1.8 million from a finance company. An arrangement was made at the date of acquisition for the liability. Once a company buys an asset, the company has an obligation to pay for that asset. That obligation to pay the liability. So we are told an arrangement was made that at the date of acquisition for the liability for the plant to be settled by our company 𝐼𝐍 Limited by issuing 10% roll notes dated 2025 to the finance company. So the company will not pay for this plant in cash, but the company will issue roll notes. Roll notes, these are debt instruments having some value. So the finance company will be issued with roll notes free of charge. So then we are told the value by which the roll notes exceeded the liability of the plant was received from the finance company in cash. Now, in this case, what we need to do, basically, we know roll notes. Once a company issues roll notes are the same with the debentures. So these ones are accounted for by the company, the balance sheet, in the statement of financial position as a non-current liability. So can we go to the non-current, to our statement of financial position we have at the paragraph 1, specifically where we have non-current liabilities. So can you see the non-current liabilities? Non-current liabilities in our statement of financial position. In that case, we have 10% roll notes. Can you see the 10% roll notes, which are dated 2025? The roll notes which are dated 2025. I hope you can see that under the non-current liabilities. Can you see this? Can you see this? Please confirm whether you can see this in the statement of financial position. 10% roll notes. Yes. Now, the 10% roll notes, we are given two balances. We are given two balances. We're given the roll notes for 2021 and basically 2022. So remember the current year ended this date. So meaning that anytime you come across a question for cash flow, the examiner will give you statement of financial position for 2 years. Statement of financial position for the current year and the previous year. Now, the balances which are given here, these ones, we treat them as opening balances during the current year, and these ones are the closing balances. It basically means that the roll note, 10% roll notes at the start of the year at the non-current liabilities, they had a value of 5250, and basically at the end of the year, they had a value of 8250. What that means is that these 10% roll notes, they increased from this to this. So how much is the increase? How much is the increase? The increase in this case is basically equal to 3,000. So these 3,000 are the roll notes which were issued by the company during the current year. Now, what you are told is that these roll notes, they were issued to a finance company. They were issued to a finance what? Company. And these roll notes, which were issued by the company, some of them were issued to pay the plant which was acquired. So the plant which was acquired as per note number 1, the plant had a value of 1,800. And therefore, we are told the difference between these roll notes which were issued to the finance company and the roll notes which were issued to pay for the plant, which basically in our case will be 12. This amount here was received in cash. This amount was received in cash. The company issued roll notes having a value of 3 million. So these roll notes were issued to pay a plant which had a value of 18, and basically the difference, which is 12, was received in cash. In preparing our statement of cash flow, what we will consider are this particular, or is this a particular amount which was received in cash, because these roll notes which were issued, which had a value of 18, so no cash which was received. In other terms, we can say that this is a non-cash item, is basically a non-cash item. And if you can be able to recall, in preparing our statement of cash flows, we only consider those transactions which involve cash inflow or cash what? Inflow. Remember, from our definition, we said a statement of cash flows is prepared to show the sources of cash and the application of cash. So we only consider transactions involving cash inflow and cash outflow. So what we will consider here is basically the roll notes which were issued for cash. Which were issued for cash, this one. So these ones will not be considered. Will not be considered. Equally, this plant, which was purchased by the company, you can see the company didn't pay for that plant in cash. So we will not consider that. So if that is clear, I want us to move to note number 2. In note number 2, we are told that the company's motor vehicle haulage fleet with a cost of 2.63 million and accumulated depreciation of 1.165 million was disposed of for a cash profit of 1.81 million. So automatically we know that once the company sells an asset, we must determine was the asset sold at a gain or at a loss. This is something we came across in the topic of published financial statements. And you are told the profit on disposal has been included within operating expenses. So in relation to that disposal of asset, we need to determine was there a gain or a loss on disposal? Was there a gain or a loss on disposal? How do we compute this one? We take the sales profit. The sales profit is basically the amount at which the asset was sold at minus the net book value, which is also known as the carrying amount. And actually, we know that the net book value, this one is equal to the cost minus accumulated depreciation. So let's compute this one. It's also important for you to note that this gain, this is also known as the profit on the sale. The profit on the sale of asset. So this asset which was sold, as per note number 2, we are told it had a cost of 2.63 million and accumulated depreciation of 1.165. So that will help us in terms of computing the net book value. It's also important for you to note that if you go back to the income statement, the statement of financial position, our figures are in thousands of shillings. We have to be consistent by working with all our figures in thousands of shillings. Any figure we take from the additional information, we are going to omit the last 3 zeros, like what we have done here. So the net book value here will be equal to the cost, 2630, minus accumulated depreciation, 1165. That will give us the net book value. And then you are told this motor vehicle haulage fleet was sold for a sales profit of 1810. So we take 1810 minus this one, minus the net book value, minus the net book value. So what will be the net book value for these motor vehicles? 2630 minus 1165. So which will give us 1465. So the difference here is what? I'm getting 345 Is that what you're getting? Yes. And automatically in this case, by applying this formula, if you get a positive figure is a gain or a profit. If you get a negative figure is a loss. So you can see this is a positive figure. So this means that this is a profit, or basically what? A gain on the disposal of assets. Sawa? Yes. So then let's move to the other point, number 3. We are to depreciation charge on property, plant, and equipment during the current year was 5 million for 90,000 and was included within the cost of sales. Do we have any adjustment or any working required for this? No. Number 4, we are told intangible assets were amortized during the year, and amortization charge to the profit or loss amounted to 540,000. Amounted to 540,000. So is there any working which is required in relation to that? No. So, but we need to remember that this one will be adjusted in the profit. But can we go back to up there where we have non-current assets in the statement of financial position? So we have two assets, PP, and actually PP, you can remember from a previous topic, these are tangible non-current assets. So below PP, we have intangible assets. So if you check on the value for intangible asset, the value increased. But if you can remember what you're told in note 4, there was amortization. Amortization basically reduces the value for intangible assets. So, but in our case, you can see the intangible asset did what? Increase. So what we need to do here, we need to prepare that account called the intangible assets account. We see what caused the value for the intangible asset to increase. What caused the value for intangible asset to do what? To increase. What caused the value for intangible asset to increase? To increase. What caused the value for intangible asset to do what? To increase. So how do we prepare this account? Remember, this is an asset account. So what we record on this side is the value for intangible asset at the start of the year, balance brought down. On this side, down here, we record the balance carried down for intangible assets. On this side, we record amortization. Amortization basically reduces the value for intangible assets. And also on this side, we record the disposal or what? Or sale. There is no way we are told there were intangible assets which were sold. On this side, we record acquisitions. Were there some intangible assets which were acquired? So in this case, we just need to do what? We just need to plug in the items which are given. We have the opening balance and the closing balance in our statement of financial position. In our statement of financial position for 2021, the intangible asset was 6150. Remember, that is the opening balance. The figures given here are the opening balances. The figure given here are the closing. So the intangible asset at the end of the year was 6750. And then in note number 4, we have amortization, this one, which is 540. So in our case, we don't have what? We don't have disposal. Automatically, if you add this and this, you can see it's more than this. It basically means that during the current year, there were some intangible assets which were acquired, which you can only be able to compute by preparing this account. So let's add what we have on the credit side, 540 plus 6750 minus what we have on the debit, 6150. So this will give us 1140. 1140, these are intangible assets which were acquired. So this one will be considered in our cash flow at the investing activities. So number 5, we are told during the year, which ended 30th of April 2022, 𝐼𝐍 Limited made a bonus issue. We know a bonus issue is issue of shares free of charge. So is a non-cash transaction. We don't consider this in preparing our statement of cash flows. These are shares issued by the company free of charge, and basically they are financed by the company from the share premium or the retained earnings. During the year which ended 30th of April 2022, 𝐼𝐍 Limited made a bonus issue of ordinary shares for 1 share for every 10 shares which were held by utilizing the share premium. So let's compute how many shares were issued during this bonus issue. So the first thing we need to do basically is to determine how many shares had been issued by the company at the start. Those are the shares we are going to use to determine the bonus issue which was made during the current year. For me to be able to do that, I hope you can be able to remember in the previous topic, we also computed, we had a transaction, we had a similar transaction. So let's go to our statement of financial position, to the statement of financial position of our company here, specifically at the equity. At the equity, we are interested with ordinary share capital, specifically at the start. So what is the ordinary share capital of this company at the start? I can see it is 6,000. Are these the number of shares? No, this is the share capital. For me to be able to get the number of shares, I need to divide that with the par value per share. I can see the par value per share, we are told is 10. So meaning that at the start of the year, the shares which had been issued by the company were 600. So having this then, and I hope you can see we are not using the shares issued at the end, because the shares issued at the end, the company had already accounted for the bonus issue. The reason why it is important for you to compute the value of the shares which were issued during the bonus issue is because these shares, we don't consider them. We will not consider them in preparing the statement of cash flows. The moment the company issues shares or bonus shares, no money which is received from those shares. And we have said in preparing the statement of cash flows, we only consider transactions involving cash inflow and cash outflow. So this transaction bonus issue, we have to exclude that. We cannot include that or take into account that in preparation of the statement of cash flow because it is a non-cash item. So in our case, we are told, let's go back to note number 5. We are told during the year which ended 30th of April 2022, Maram Limited made a bonus issue of ordinary shares of one share for every what? For every 10 shares which were held. So basically in our case, we know the shares which were held at the start, they were 600. There were 600 shares. So we need to cross multiply, then we divide, so that we determine how many shares were issued during the bonus issue. So we have 1 times 600. We divide that with 10. And basically this will give us 60 shares. And we said that during a bonus issue, always shares are issued at what? At par value. The shares are issued at par value. At par what? Par value. So meaning the total value of the shares issued during the bonus issue would be 60 times 10, basically which will give us 600. So how do we account for these shares which were issued during the bonus issue? Take into account in note number 5, we are told they were financed by the company from the share premium. So the double entry for this is that we credit the ordinary share capital. We debit. First of all, we credit ordinary share capital. The ordinary share capital basically increased, and then we credit the share premium. The share premium. So the company utilized the share premium to pay for these what? Shares. So therefore, what we need to do here, we need to prepare those two accounts. Let's prepare these two accounts so that you see what we mean by debiting and crediting each of those two accounts. So let's prepare these two accounts. We start with the share premium, the share capital account. So we start with this one, the ordinary share capital account. So the ordinary share capital account, what do we record here? This being a share capital account, on this side we record the opening balance. Remember all items of equity from the acronym I gave you, DIDA. All items of equity, they have a credit balance. So the opening balance should be there. The closing balance, we record it on this side. Then on this side, we record the shares which were issued during the current year. So the shares which were issued during the current year, this will comprise the shares issued during the bonus issue and also the shares which were issued for cash. Then on this side, we have maybe the shares which were redeemed. We don't have such a transaction regarding the shares which were redeemed. So maybe first of all, we can just record these figures, plug in these figures. So can we go to where we have the equity section? Under the equity, we have ordinary share capital at the start. I hope you can see the ordinary share capital at the start. Can you see that figure? Can you see that figure? The ordinary share capital to the start, was it 6,000? Yes or no? Can you see that figure, ordinary share capital to the start? Yes. And then the share capital at the end was 75. Then on this side, we record the shares issued in cash and free of charge. So we know the shares which were issued during the bonus issue are this one, 600. So if you add this will give us 66, and this will give us 75. So you can see we have shares here which were issued for cash. The shares which were issued for cash here is basically an amount of how much? 66 minus 75. That will give us what? That will give us 900. Now, this 900, this is what we will consider in preparing our statements of cash flow. We don't consider these shares which were issued during the bonus issue, no money which was received. Yes. So we also need to do the same in this account. Let's prepare this account, the share premium. The share premium account. The share premium account. Share premium account. Now, for the share premium, we do the same. We record the opening balance on this side, the closing balance on this side, Then, on this side, we record the amount which was received during the current year from the shares which were issued at a share premium. If the company issued some shares during the current year, they were issued at a premium, that one should be credited there. And then on this side, we debit this. So once the company issue bonus shares, we know that those bonus shares will be financed, will be paid from the share premium. The share premium which was there at the start, we reduce. That's why we have said these shares which were issued free of charge, we credit that here, we debit that in this account. It reduces the share premium. So the bonus issue, which we know is 600. So can we record now what we know? Still at the equity. So we start with the opening and closing balance. So the share premium at the start, I hope you can see that still at the equity. Share premium at the start, 1050. Share premium at the end, 1350. So basically in this case, if we add what we have on the debit, it will basically give us 1950 minus what we have on the credit, which is 1050. So this will give us 900. It basically means that these shares equally, which were issued during the current year for cash, there was a share premium on them. This share premium still represents the cash which was received by who? By the company. In form of premium. In form of a premium. And in our case, we are basically done, but there is an account which the examiner will not tell you to prepare. This is something you must be able to note as far as this question for cash flows are concerned. And which is that account? The PP account. If you check on the additional information given in note 1, 2, 3, I think they affect PP, but we must prepare the PP account mostly to determine were there some items of PP which were acquired. We prepare the PP account. PP account, the property, plant, and equipment account. And basically, what do we record in this particular account here? So remember, this is an asset account. We always start by recording the opening balance here on the debit side. On the credit side here, we record the closing balance. Then on the credit side, we record those transactions which reduces the value of asset, the value of the asset which were there at the start, like the disposal or basically sale, like the depreciation, like any revaluation loss. And then on the debit side, we record those transactions or those items which increases the value of asset, like what? Like acquisitions, like revaluation what? Revaluation gain, of which in this case, here we have, first of all, this plant which was acquired. I hope you can remember this plant which was acquired, which had the value of 18. This, remember, was acquired and no cash which was paid for it. So this is a non-cash transaction or a non-cash item, but we also need to determine were there other items of PP which were acquired in cash. And basically that is the main objective of preparing this account. Were there some items of PP which were acquired in cash? But even before we do that, can we record the obvious items? We start by recording the opening balance in the PP. This one is in the statement of financial position under the non-current assets. So the PP at the start, I hope you can see that, is 27,450. The PP at the end of the year is 36,300. And then can we go to the additional information? In the additional information number 1, we have this item of plant which was acquired by the company, and the company paid for that by issuing what? By issuing the 10% loan notes. We have said this is a non-cash transaction. Sasa, we have already recorded that here. Number 2, we have the motor vehicles which were disposed. These motor vehicles which were disposed is part of the PP because these include all tangible and current assets. Assets which are disposed, we record them here at the net book value. The net book value for this plant which was disposed is that figure here, 14,65, which is basically cost minus accumulated depreciation. If you go to note number 3, we have the depreciation, this one, 5490. Then what we need to do is basically to check, was there a revaluation gain or loss? This revaluation gain or loss we can only be able to know whether there was a revaluation gain or loss by going to where we have the income statement. Can you go to the income statement? Income statement, the last item. The last item within the statement of profit or loss. Can you see we have a gain on property revaluation? Gain on property revaluation? Yes. So that gain on property revaluation is a revaluation gain, which we record here. 20 to what? 50. And actually, we don't have anything else. So basically, in our case here, we don't have a loss. So the main objective of preparing this account is to determine this. Well, there are some items of PP which were acquired in cash. So let's add what we have on the credit side. 1465 plus 5490 plus 36,300 minus basically what you have on the debit. 27,450 minus 1,800 minus 2550. Yes, so here I'm getting a balancing figure of 11,455. Is that what you're getting? Are you getting such a figure? If yes, please confirm. Is that what you're getting? I'm waiting for the confirmation so that now we move and basically prepare our statement of cash flows. I'm told it is 12,445. Helen, which figure is correct? Helen is getting 12,455. What are you getting here, Aaron? Yes, what are you getting here? Zipporah, Francis, Lucy, Virginia, what are you getting here? Yes, I'm told it should be 11,455. I think now having that, what we need to do, can we move and prepare a statement of cash flows? Let's proceed and prepare a statement of cash flows. So the name of this company is Maram Limited. And this is a statement of cash flows. A statement of cash flows for the year which ended 30th of April 2022. That year of April 2022. That year of April 2022. So here we start by determining, this is basically what you need to recall. We start by determining the cash flow from operating activities. Then from there, we proceed determine cash flow from investing, cash flow from financing. So here we also need to have two columns. We need to have two columns, and basically our figures are in thousands of shillings. And then you also have to recall, in our case, we are required to use which method? We are required to use the indirect method. And the indirect method, I said always we start with the profit before tax. So can we get that profit? So we will go back to the income statement and we take the profit before tax. The profit before tax will give me that figure. The profit before tax from the income statement, profit before tax, I can see that is a figure of 8190. Can you get that figure? Is that the figure you have from the income statement? Yes. So then to this, we have said we need to make a number of adjustments. Which adjustment do we make to this particular profit? We have said the first adjustment is basically to add back the interest, or to add back the finance cost. So the finance cost, or basically the interest, this one we have it just above this, just above that profit before tax. We have the interest, and basically in that case, the interest of the finance cost is what? Is 705. I think I've explained why we do that. For us to have the profit before interest and tax, or the operating profit. After that, then we proceed, after having the profit before interest and tax, we proceed and adjust this profit with three categories of items. Non-cash items, which you need to remember the acronym 𝐷IAL-G. Changes in working capital, investing and financing activity items added or deducted in arriving at this. So let's start with the non-cash items. And basically we can have this acronym 𝐷IAL-G. 𝐷IAL-G. Basically I've said this is amortization of intangible assets. This one stands for loss on disposal. This one stands for the gain, or basically profit on disposal. That's basically what you need to recall. Then this one stands for what? For depreciation on property, plant and equipment. And this one stands for impairment loss. Impairment loss is basically the decrease in value of goodwill. But if you check on this particular question here, we don't have goodwill. Mostly this one, you come across goodwill in those particular questions for group accounts. Like once you go to the advanced level, you'll be looking on how to prepare a group cash flow. And basically, in a group, we always have impairment loss of goodwill. So that is basically something we will be able to discuss in our next topic, the topic of group accounts. So we don't have this one, but we have the depreciation. I hope you can remember this depreciation, which is given in note number 3, 5490. And I've said the first 4 items, this one should be added to the profit. This one should be added. Equally, this should be added, and that should be added. This one should be deducted, because these 4 items, these are items of expenses. In arriving at this, they were deducted, but they are non-cash items. We add them back. The gain is an income. In arriving at this, it was added, but is a non-cash item. We do what? We less. So then in this case, we have amortization. Amortization, we have it in note number 4. Amortization, which is 540. We add it. Then in this question, we don't have a loss on disposal. We have a gain. The assets which were disposed, the motor vehicles disposed as per note 2, they were disposed at a gain or at a profit, which we computed here. of 345. So that gain we less it. We do what? We less it. Sasa? Yes. So then from there, what we also need to do is basically we check whether in arriving at this profit, do we have investing or financing activities added or deducted? So we can only be able to get that now from the income statement. Can we go back to the income statement which you have given? From the income statement. In the income statement, we have revenue, or the statement of profit or loss, we have revenue, cost of sales, gross profit. And then from there, we have something called the government grant. Now, government grant, basically what is this? Government grant refers to any form of or any financial assistance which a company gets from the government to undertake maybe a project meant to benefit the members of the public. Like in this case, the company can receive a government grant of 2 billion to undertake a project, a project. So which is meant to benefit the members of the public. So once this 2 billion is received, how does the company account for this? The company debits the bank account 2 billion, and then the company credits an account called government grant. So if we go to where we have liabilities, you'll be able to see something called the government grant. And because this money does not belong to the company, it's supposed to be spent maybe like for the next 2 or 3 years in terms of undertaking a project. Then what the company should do is to amortize this amount for the next 2 or 3 years. To amortize is to write it off. Is to write other incomes within the income statement. But this amount which is amortized, remember, this does not represent the money which was received. So therefore, that amount which we have in the income statement below the gross profit is the amount which was amortized during the current year and actually recognized as an income. Does it represent the government grant which was received during the current year? Automatically no. So therefore, this amount of 750, the government grant, grant of 750, this is the amount which was amortized and actually accounted for as an income, but basically that is a non-cash item. That does not represent the government grant which was received during the current year. So therefore, this is a non-cash item. Take into account in arriving at this profit, it has been added. That's why you can see that amount there is a positive. It is included here. And because it's a non-cash item, what we need to do, we need to less it. Just like what you have done to that gain. It is included here. Is a non-cash item. We do what? We less it. We do what? We less it. So that government grant, which was amortized, we do what? We less it there. Okay. So I don't think we have any other item within the income statement. Within the income statement, I don't think we have anything else. I don't think we have anything else. So basically what we need to do here then is we get the net amount and then we consider the changes in working capital. So let's get the net amount here. Give me the net amount. Give me the net amount. We try to hurry up because of time. So we have 8190 plus 705 plus 5490 plus 540. Okay. So I'm getting 13,830, 850, 13,830, not 850. Is that what you're getting? Is that what you're getting? Yes. So then from there we proceed and basically we consider the changes in working capital. Now for the changes in working capital here, basically, I've said we consider 3 items. Just remember this acronym. RIP, receivables, inventory, payables. Those are the 3 items of working capital which we consider here: receivables, inventory, and what? And payables. Now, as far as these 3 items are concerned, what we just need to do is to determine whether there was an increase or decrease during the current year, as far as those 3 items are concerned. And then you determine whether that increase or decrease is an inflow or outflow. Now, to make this work, to make your work easier here, use this formula. For receivables inventory, use this formula: opening balance minus closing. Here you take opening balance minus closing, and here you take closing balance minus opening. Always be using those formulas. Whatever you get, if by applying that formula you get a positive figure, record it as a positive, is an inflow. By applying this formula, if you get a negative, record it as a negative, it is an outflow. You just need to remember that formula. For receivable inventory, opening minus closing. Payable, closing minus opening. Sasa, can we go to where we know receivables and inventories are part of current asset. We start with the inventory. The inventory, I will take this formula: opening minus closing. So inventory at the start was 445 minus closing, which is 13,300. That will give us negative 855. That is basically a cash. That is inventory. That is basically cash what? That is cash outflow. That is cash what? Outflow. Are you getting that figure? Please confirm. Please confirm. Please confirm. Please confirm. Are you getting that figure? Yes. Now we move to the other item, receivables. We do the same. 7080 minus 9230. I'm getting negative 2150, still cash outflow. Cash outflow. Then I'll go to where we have current liabilities. Payables is part of the current liabilities. So the payables, I'll take closing minus opening. So 10,200 minus 770, which will give us 2430, which is basically what? A positive, which is a positive. Then I'll get the summation. I'll basically add all this. I have 13,830 minus 2150 minus 1855 plus 2430, which will give me 12,255. And then now to this, I'll basically proceed and less two items: tax paid and the interest which was paid. Those are the two items. Then I will proceed and I less here. So for the tax paid, I basically need to check for how many items? For 3 items. For 3 items. Do I show you how to prepare? Let me show you how to prepare an account here. Ledger account. Because for tax, basically we have a number of items. But even before I show you how to compute the tax, let me show you how to compute the interest. Now for the interest, we consider 2 items. We go to where we have the current liabilities. Under the current liabilities, can you consider, do we have any interest payable or accrued interest under the current liabilities? Under the current liabilities, yes or no? Yes, so therefore say to compute this interest, we go to where we have current liabilities, check whether we have any accrued interest or interest payable. In case you have any, we take the accrued interest at the start plus the interest from the income statement minus the accrued interest at the end. So basically we get what? The interest which was paid. But now for the tax, we may be required to prepare the tax account because we basically have a number of items affecting this tax account. So what do we record in this account? One, on the credit side, we go to where we have non-current liabilities. You check, do we have a deferred tax at the start? In case we have a deferred tax, record it here. Under the current liabilities, check whether we have current tax at the start and then at the end of the year, deferred tax and the current tax. And then also on this side, you take the tax for the current year from the income statement. And then from there, you balance your account here. The balancing figure on this side represents the tax which was paid. And basically that's what we want to compute. So can we first of all record this? The deferred tax and the current tax are the liabilities. Under the non-current liabilities, I can see deferred tax at the start, 810, at the start, the deferred tax at the end, 1920. Under the current liabilities, I can see current tax of 2775 at the start, at the end is 2685. Then I will go to where we have the income statement. In the income statement, I will take the tax for the current year. The income tax for the current year from the income statement is 2655. Basically, by doing that, I'll be able to compute the tax which was paid, which is basically the balancing figure on the debit side. So I'll take what we have on the credit, 810 plus 2775 plus 2655 minus now what I have on the debit, 1920 minus 2685. Basically, that give me 1365. So the tax paid is 1365. So confirm whether that is what you're getting. And basically that now will give us the net cash flows from the operating activities, Is that what you're getting? And remember, these are cash outflow. I'm waiting for the confirmation, please. Okay, so that basically now our net cash flow from operating activities. So having that, then we need to move and basically we determine the cash flow from investing activities. So this one is basically quite simple. In fact, much of the work is here, how to determine the net cash flow from operating activities, because here we just need to consider the asset which were acquired and the asset which were disposed. So let's do that. And I think we have those workings. We have all those workings. We have computed all those items which were acquired and the ones which were disposed. So this one is quite simple. So maybe we can start with this one, the PP. So for the PP, we said we will consider these items of PP which were acquired in cash. So we say there was acquisition of a PPE. And remember, in this case, we said once the company acquired PPE, these are cash outflow. We record that in the first column, 11,455, which is a cash outflow. So we will not consider this because these are non-cash transaction. Then from there, for the intangible assets, we also say that there was acquisition of intangible assets. These ones, was it 1140? These intangible assets which were acquired, was it 1140? Was this one correct? Intangible assets. Yes. So then basically also these are cash outflow. Then in the additional information, note number 2, we have these motor vehicles which were disposed. We have disposal of motor vehicle. So once the company sell an asset, what we consider here is the amount received. Cash received, which is 1810, of which in this case, I don't know if you have anything else. The other item which you may consider here is investment income. Do we have any investment income? No. So let's get the net amount. We take it to the last column. The net amount, we take it to the last column here. So we have negative 11,455 minus 1140 plus 1810. So which will give us negative 10,785. Then finally, please confirm whether that figure is correct. So finally, we determine the cash flows from financing activities. So remember here we have said all the items which we include here, we get them from the statement of financial position, specifically at the equity and at the non-current liabilities. That's why we get the items to be used in the computation of this. So can we go to the statement of financial position first of all at the equity? So at the equity, the first item which we have there is what? Is ordinary share capital. Remember, we have already prepared that account called the ordinary share capital account. And basically we said that there are these shares which were issued for cash. And that basically what you're going to consider here. Issue of ordinary shares. We consider the shares which were issued for cash, this one. Then below that, we have the share premium. And basically we said that there was this increase in share premium, which represents the share premium received in cash, increase in share premium. It basically means that these shares which were issued, they were issued at a premium, which is still a cash inflow. Below that, we have revaluation surplus. That one, we don't consider it here in our cash flow. The reason why we have revaluation surplus is because there were assets which were revalued. This is a non-cash item. We don't consider that here. Below that, we have the retained earnings. Now, the retained earnings, we use that to compute the dividends paid. How do we compute the dividends paid? Dividends paid, these ones are computed using this formula. You may need to write this formula somewhere. So the dividends paid, these ones are computed by taking the retained earnings at the start plus profit after tax minus the retained earnings at the end. That formula, make sure you write it somewhere. So that is basically the formula we will apply here. We will take the retained earnings, or the retained earnings is the same with the retained profit at the start, which is the 25,980. Plus to this I will add the profit after tax, which is from the income statement. The profit after tax is the same with the profit for the year from the income statement. I hope you can see that. 55, 35, and then to this I will less the retained earnings at the end, which is 28,065. So the difference here basically represent the dividends which were paid. How much dividends were paid by this company? 25,980 plus 55,35 minus 28,065. I'm getting dividends which were paid of 34.50. 34.50, yes. So basically we are done with that. And I hope you can see we are done with all items of equity. Then we go to where we have non-current liabilities. Non-current liabilities, we have two items. We have three items, sorry. We will only consider two. Remember, you have already dealt with the deferred tax in computation of this. So here we will only consider two items. The 10% loan notes, we have already dealt with that because we said the loan notes which were issued had a value of 3,000. Loan notes having a value of 1,800 were issued to pay the plant which was acquired. So this we said is a non-cash transaction. We will not consider that here. What we will consider are these loan notes which were issued for cash. So we say there was issue of 10% loan notes having a value of 1,200 in cash, and basically that is a cash inflow. So we record it as a positive. So then from here, what else do we have? We have now the government grant. Now for the government grant, is also advisable for you to prepare an account. I'll just show you how we prepare that account. The main objective of preparing the account called the government grant is basically for you to determine, were there some government grants which were received during the current year? The government grant account. So this account, you can see is part of a liability. We record the opening balance on this side, the closing balance on this side. Then on this side, we record the government grant which were received during the current year. And the other entry should be in the bank. In this case, we record the government grant which were amortized. And basically which are in the income statement. I hope you can remember this government grant which were amortized, which are in the income statement. This value here of 750. Having that, then we can record the opening and closing. Remember, what you want to determine here, are there some government grants which were received during the current year? In case there are some government grants which were received during the current year, we consider that here. Remember, you have said a government grant is basically a financing to a company to undertake maybe a project which will benefit the public. So how much is the government grant at the start? It's also important for you to note that this government grant, part of it is recorded at an non-current liabilities, part of it at the current liabilities. We need to capture those figures here. So under the non-current liabilities, we have a government grant of 24 at the start. At the end of the year, it is how much? It is 3150. And still under the current liabilities, we also have government grant. Here 600, here 810. So those are the items which we have. Having said we need to balance our account, we determine, were there some government grant which were received during the current year? Let's add what we have on the debit, 750 plus 3150 plus 810 minus what you have on the credit, 24 minus 600. And in this case, I can see we have a government grant of 1710. So this is the government grant which was received by the company during the current year. It's a form of a financing. Are you getting that? Government grant which was received. Are you getting that amount? 𝐉𝐻, please confirm. 𝐉𝐻, please confirm. Francis, are you getting that? Yes, that is confirmed by Hassan. And basically, in our case, we are done because you can see we don't have any other item other than non-current liabilities. So we can now get the net cash flow from financing activities. So we take this plus this, which will give us 18 minus 3450 plus 1200. And then this is still a cash inflow plus 1710, which is 1260. Then I will get the net changes in cash and cash equivalents. So the net changes in cash and cash equivalent, basically I'll have to add three values. This one, A, plus this one, which is B, plus this one, which is C, this one. So I will add A plus B plus what? Plus C. So I'll start with that one, 9915 minus 10, 785 plus 1260, and that will give us 390. I'm getting 390. So please confirm whether that is what you're getting, sir. Is that what you're getting? This minus that plus that one. Okay. Yes. Now having that, we need to move, and basically we add the cash and cash equivalent at the start. Have I received any confirmation? Yes. So the cash and cash equivalent at the start of the year So remember, we have said for cash, we consider cash in hand, cash at bank. Cash equivalent, we consider the short-term investment. So can we go to where we have current assets? So under the current assets, which items of cash and cash equivalent do we have there? I think, in fact, you're given the cash and cash equivalents at the start and also at the end. So we just need to add to take that final figure. The cash and cash equivalent at the start is 510. And then basically we are going to add the two, we will get the cash and cash equivalents balance carried down. So can we add those two figures there? 390 plus 510. Basically that should give us 900. 900. And actually this one should always tally, should always reconcile with the amount we have in the statement of financial position. You can see in the statement of financial position, the cash and cash equivalent at the end is what? Is also 900. Is also 900. So meaning that in our case, basically we are what? We are correct. We are correct. I think Noor have indicated here how I've computed the cash and cash equivalents. I hope you can see where we have A, B, C, and D. So that is A, B, and C. So we add those three values. This plus this plus that plus that. That should give us 9,390. Is that what you're getting? Is that what you're getting? Please confirm whether that is what you're getting. Yes, yes. So basically that brings us now to the end of that particular question. It's a very good question on cash flow. So for today, equally, we stop at that point. So you can attempt the question which was there last sitting. There's a question last sitting April 2025. You attempt that question. That is the question we will be able to do in our next class. We will try and do 2 questions on cash flow. So that we wait that, and then we move to something else. Remember, right now you have less than 2 months for you to do your exams, so you should start revising. Equally, want us we finish with the syllabus, preferably by 10th. By 10th of next month, we should be done, because right now I think the main topic which is remaining is group accounts. We have other small topics which are remaining, but the main topic which is remaining is the topic of a group account. In fact, once we are done with this cash flow, our next topic should be the group account. Sasa, yes. So we stopped at that point for today. We continue from there on Thursday as we wind up on this topic. So have a good night. See you on that. need to record. Statement. So basically what we know is that once the year has come to an end, a company or basically a business entity has to prepare financial statement. So the financial statement prepared at the end of the year majorly include the income statement and also the statement of financial position. And this particular financial statement, the income statement and the statement of financial position, they provide limited information to the users. For example, if you're given the income statement of the company, you can only be able to get information about the profit or loss. You can only be able to get information about the financial performance of the company. If you're given a statement of financial position, you can only be able to get information about the financial position of the company. But now, that information which is contained in the income statement and the statement of financial position, for it to be of more use to the users of the financial statement, that information need to be analyzed further. And actually, we have various tools or basically various techniques which can be used in performing that particular analysis or in undertaking that particular analysis. And remember, these tools, you are able to discuss them in financial reporting and analysis. And therefore, here we're going to look on three tools or actually three techniques which as an accountant, which as a financial analyst you can use to further analyze the information which is contained in the income statement and the statement of financial position for more information to be extracted, which you are saying can help the users in terms of making a more informed decision. So which are those particular tools? There are three. One of it is called the common size analysis, and this one is also known as the vertical analysis. Number two, we have the trend or horizontal analysis, and number three, we have the ratio analysis. We're going to start with the first tool, which is the ratio, not the ratio, sorry. I want us to start with the common size or the vertical analysis of the financial statements. So what do you mean by this? The vertical or basically the common size analysis. So these are all basically this particular tool here. What we do, we express the items within the financial statements as a percentage of a certain base item. For example, when talk about the common size income statement or the vertical analysis income statement, what we do, we express all items within the income statement as a percentage of sales or basically as a percentage of revenue. So mean that you'll be given an income statement which was prepared by the company, and if you're required to do a common size or to undertake the common size or the vertical analysis, you are required to express all items within the income statement as a percentage of sales or basically as a percentage of revenue. Why or what is the importance of this? Why do you have to express those items in the income statement as a percentage of revenue or as a percentage of sales? The objective of this is to know the relationship between the sales and the items within the income statement. For example, assuming you have computed the cost of sales and maybe you have gotten or you have computed the cost of sales as a percentage of revenue, and maybe you get something like 70%. It basically means that for every sales which are, or basically for every or sales which are made by the company amounting to 100 shillings, if the company makes sales amounting to 100 shillings, then the company uses 70 shillings to buy the goods which were sold. So those goods which were sold at 100 shillings, they were bought at shillings 70. If, for example, you compute something like administrative expense as a percentage of revenue, as a percentage of sales, you get something like 10%. It basically means that if the company makes sales of 100 shillings, the company then uses 10 shillings to pay the administrative expenses. So that's why it is important for the common size or the vertical analysis to be undertaken to provide more information to the users for their decision making. So therefore, here we have said the common size or the vertical analysis. What we do is that we express items within the financial statement either as a percentage of the total assets, as a percentage of either the total assets, or basically as a percentage of the total sales. And specifically, I've said we have the common size statement of financial position. So this one is basically prepared by expressing all items within the statement of financial position as a percentage of total assets. So mean that if you're required, you come across a question, you're required to prepare a common size statement of financial position, what you need to do is to express all items within the statement of financial position as a percentage of total assets. Okay, so can you hear me now? I don't know what happened with my internet. Kezia, Ronald, Josephine, can you hear me now? Okay, so I think we can proceed. Let me share this afresh. Yes, so in this case, I was explaining what is the common size statement of financial position, or basically the vertical analysis of the statement of financial position. And basically, I've said that this one is prepared by expressing all items in the statement of financial position as a percentage of assets, as a percentage of total assets. You express all items as a percentage of total asset. And basically, to do that is quite simple. If you're given something like inventory, you will take the value for the inventory, divide that with the total assets, and then you multiply that with 100. You multiply that with 100. So the common size or the vertical analysis of the income statement, this one is prepared by expressing all items in the income statement as a percentage of sales, or basically as a percentage of revenue. And I think I've explained what is the importance of that doing that. I've said it's to know the relationship between sales or between revenue and the items within the income statement. So therefore, that basically what you mean by the common size or the vertical analysis. So this is a type of analysis which is done to express the items within the financial statement as a percentage of either the total assets or the total sales. Number two, we have the trade percentage analysis, which is also called the horizontal analysis. Now, this is a type of analysis which is done in order to establish the change from 1 year to another year. For example, in this case, we can be given financial statement for 2 years, 2023, 2024. And in this case, we are required to do a trend or basically horizontal analysis of 2024. So what we need to do is basically to determine whether the figures in the year 2024, in the financial statements of 2024, whether those figures increased or reduced as compared to the previous year. The previous year, which is 2023, we consider that as the base period. The base period means that we are using 2023 to determine whether the figures in 2024 increased or reduced. So mean that after doing that comparison, we must show the increase or decrease. We must show the increase or decrease. And other than showing the increase or decrease, we must proceed and express that increase or decrease as a percentage. As what? As a percentage. So if, for example, there was an increase in sales by 100 million, so what is on that increase of 100 million is which percentage? I'll be able to show you how we compute. We express those increase or decrease as what? As percentage. So therefore, the trend or the trend percentage or the horizontal analysis, basically this is a type of analysis which is done to determine whether the figures in a certain financial year increased or reduced as compared to the figures for the previous period. The previous period, basically I've said, is always considered to be the base year. Then from there, we have the other tool, which is the ratio analysis. The ratio analysis is this one is quite simple because this one entails computation of what? Of ratios, computation of ratios. So mean that here, you'll be given the income statement, you'll be given the statement of financial position, and basically what you're required to do in such a case, is basically to do what? Is to compute various ratios, to compute various what? Ratios. Now, equally, if you can be able to recall from whatever you did in financial reporting and analysis, first of all, a ratio is a relationship between two financial variables. Like in this case, you can take the sales, and maybe you're required to express, or maybe something like the gross profit, you're required to express that gross profit as a percentage. You're required to express that gross profit as a percentage of the sales. You take the gross profit, you divide that with the sales times 100. So if you get something like 30%, that is a ratio. It shows the relationship between the gross profit and the sales or the revenue. The gross profit or the revenue. Now, in this case, we have various categories of ratios. They include the profitability ratios. And actually, for these ratios, what is important for you to know is the formula. How do we compute each of the ratio? You'll be able to see some questions in this paper of BDA, whereby you're required to compute a number of ratios. And for you to be able to do that, you have to remember the formula for computing the ratios. The first profitability ratio is called the return on capital employed. How do we compute the return on capital employed, abbreviated as ROCE? So we take the profit before interest and tax, we divide that with the capital employed. And this profit before interest and tax, this in other terms we refer to it as operating profit. This one is also known as what? Operating profit, operating profit. We also refer to this as operating profit, operating profit, operating profit. So we take that operating profit or PBIT, divided that with capital employed. So how do we compute the capital employed? Capital employed is computed using two formulas. You can compute this by taking the non-current assets plus current assets minus current liabilities. Alternatively, capital employed can be computed by taking what? By taking the share capital. The share capital is basically the ordinary share capital plus reserves, and then plus non-current liabilities. In other terms, you can say that this one will be computed by taking equity, plus non-current liabilities. By taking equity plus, because equity, we know that this is share capital plus what? Plus reserves. Equity plus non-current liabilities. So those are the two formulas or the two approaches basically we can be able to use to compute the capital, employed. You need to remember those two formulas because the formula which you use always depend with the information which is provided. Then from there we have the net profit margin. Net profit margin, this one is computed by taking the net income. The net income of the company is the same with the profit after tax, divided that with the sales. And actually, in this case, we know that the sales, this one is also known as the revenue, is also known as the revenue. So, and then we multiply that with 100. The gross profit margin, gross profit, we divide that with what? With the sales. And actually, in this case, we are saying the sales is the same with the revenue, and then we multiply that with 100. So actually, all profitability ratios are expressed as a percentage. Then in the gross profit markup, gross profit all over cost of sales times 100. Operating profit margin, we take the profit before interest and tax, which we have also referred to as operating profit all over sales, or basically all over revenue times 100. The return on equity ROE, or the return on investment, the net income, which is also known as profit after tax, all over equity times 100. So these are basically the various profitability ratios. Then from there we have the liquidity ratios. The liquidity ratios, we know these are ratios which are computed to determine the ability of the company in terms of paying the short-term debts as and when they fall due. Majorly here we have two main. So one of it is the current ratio, computed by taking the current asset all over current liabilities. Then from there, we have the acid test, which is also known as the quick ratio. And this one is computed by taking what? By taking the current asset minus inventory all over current liabilities. We have another one which is called which is called the cash ratio. This one is computed by taking the cash and cash equivalent divided by current liabilities. And in this case, when we talk about the cash equivalent basically these are short-term investment. These are short-term investment. For example, investment in shares for speculation purpose. Short-term investment. Short-term investment. Yes. So those are basically the three liquidity ratios. Then from there we have the gearing. In other terms, they are also known as the leverage or the capital structure ratios. These are the ratios which are computed basically to determine the ability of the company in terms of paying the long-term debts as and when they fall due. The long-term debts, basically these include things like the debentures, things like the bank loan, and so on. So is the company in a position to pay those long-term debts as and when they fall due? One of which is called the capital gearing, or basically the debt to equity ratio. This one is computed by taking the total long-term debts. Total long-term debts include things like debentures, the bank loan, and so on, dividing that with the shareholders' equity. And then we have something called the interest coverage ratio. It is also called the interest, the times interest and the interest cover ratio. But the common name is the interest, is the interest coverage ratio. How do we compute this one? We compute this by taking the the profit before interest and tax, operating profit, all over the interest charge. The interest charge, this in other terms, is basically the finance cost for the current year. This, in other terms, is the finance cost for the current financial year. Then from there, we have the financial average. Basically, this one is computed to determine the extent to which the assets of the company are financed by the owner's capital. So actually, this one we can. Yes, I'll be able to share those notes. Kezia, I'll be able to share those notes with you. So if we are together at that point, I want us to move to a question on that, or a question coming from that topic of analysis of financial statements. I want us, in fact, we start with the most recent one. Yes, so this question here, and actually this question was borrowed from financial reporting and analysis. This was a question which was tested in the sitting of December 2024. That is the last sitting but one. It was a very simple one. It was a very simple one on common size. And because I have the solution here, I want to do away with it. And then we do the question together. So let me do away with this one. Yes, so I want us to go through this particular question here. We see what we are told, and equally what was the examiner from this particular question here. So I've said that this is a question which was tested in December 2024, sorry, last sitting, but it was question 21. So the question reads, 𝐎𝐻𝐂𝐔𝐒 Limited, a public entity, has grown in the recent years by acquiring established businesses. The directors of 𝐻𝐻𝐂 Limited have identified two potential entities targeted for a takeover. The directors believe the shareholders of the two target companies would be receptive to a takeover. As a prerequisite to the takeover decision, the directors have tasked a firm of consultants to carry out a cross-sectional analysis of the financial statement of the two potential target companies which operate in the same sector. So in our case here, we are given the statement of financial position of the financial statements of the two entities. Remember, we are told that we have this company which is called 𝐻𝐻𝐂 Limited. This company intends to acquire one of these two companies. To acquire basically means that 𝐻𝐻𝐂 Limited intends to acquire a controlling interest either in 𝐼𝐍 or basically 𝐻𝐻𝐂. But what we know is that before a company can be able to acquire another, that company may need to know the profitability, may need to know the financial stability of the company to be acquired. So in our case, we are given the statement of profit or loss for two companies, 𝐼𝐍 Limited and 𝐻𝐻𝐂. We are given the revenue here, the cost of sales, the gross profit, distribution cost, administrative expenses. We have the operating profit. We have the finance cost, the profit before tax, income tax expense, and the profit for the year. So then we are required, or not before we go to the requirements, sorry, we are also given the statement of financial position for the two companies, 𝐼𝐍 and also 𝐻𝐻𝐂. So we have the asset, which comprises of non-current asset. And the non-current asset, we have property, owned plant, right of use asset. Then we have the current asset, which include inventory, trade receivables. And then we have the bank. We have the total assets there, total assets. And then we have equity. Equity comprises of ordinary share capital, revaluation, surplus, retained earnings. We have the total equity. And then we have the non-current liabilities, which include the lease liability, the 10% loan notes. And then we have the current liabilities. We have, under the current liabilities, we have trade payables, lease liability, current tax, and then we have the total equity and liability. So what was the examiner requiring in this question here? So one, we are required to prepare the common size statement of profit or loss for the two entities for the year which ended 30th September 2024. Part B, we're required to prepare the common size statement of financial position as at 30th of September 2024. And also, we are required to advise the directors of 𝐻𝐻𝐂 on the best company to take over. So we are going to start with the Roman 1 here, whereby we are required to prepare the common size statement of profit or loss. So in this case, remember what we said is that once you come across such a question in this paper for business data analytics, we said what you need to do is basically to have your solution within the same Excel worksheet. Don't go to a different worksheet. Don't open a different Excel worksheet. But basically, you should use the same Excel worksheet to have your solution. In fact, we said what you need to do, split your worksheet into two. Like in our case, you can see I've already done something. Maybe I can just undo this, and then I show you how you should do it. So basically, this is our question. So we said within the same Excel worksheet. So basically, you can highlight that cell, that row, sorry, not cell. Highlight that column. How do you highlight a column? You just place your cursor up there, and then you click your cursor. Then you'll be able to highlight that particular that column, and then you come up here where we have these two icons. Use this one basically to shade your column like that. By doing that, you will have separated the question here from the solution. So once you separate that, you can have now the solution here. This will be our solution, will be our solution. And we said you can bold this one, you can bold this one to make it more clear. It's already bolded, but we said maybe to unbold it, we can, we said we control B, yeah? You go to your keyboard, you say control B. So basically control B is to bold it. So equally, you can come here and you shade it to make it more clear, such that the person who is marking your paper can be able to see that your solution is here. So solution, and then we start with the Roman 1 here. Roman 1 of the question. So what are we required to do? We are required to prepare the common size statement of profit or loss for the year, or for the two entities for the year which ended 30th of September 2024. So what we need to do, we see whatever you can be able to copy is always advisable you copy that, because that will be saving a lot of time. So just highlight that. You can see what I've done. You bring your cursor there, click that, hold your keypad, and then you do what? You drag, and then you do what? You copy. To copy, we say is to Control C. Control C, bring it up there. You click that word within inside that cell, and then you say Control V. Control V is to paste. So what we start with is basically to prepare a common size statement of a profit or loss. Now, what we just need to recall, what is a common size statement of profit or loss? A common size statement of profit or loss, this one is prepared by expressing all these items, by expressing all items here within the income statement as a percentage of sales, or basically as a percentage of revenue. In this case, we are going to prepare the common size statement of profit or loss for the two companies, that is Lami and Peponi. So we need to have two columns here. So we just copy what we have in the question and then paste it here. So I want us we continue with the topic of public financial statements. Specifically today, I want us to look on an illustration, and I want us to start with this question for August of 2023. Hopefully you have the question with you, August of 2023, and that is question number 5. That is the question number 5. That is what I want us to start with, August of 2023, and that should be question number 5. Should be question number 5. Yes, I hope you are there. So if you have the question with you, please confirm. Please confirm. If you have the question with you, please confirm. Okay. So what are we told in this question here? So we are told the foreign trade balance related to be delimited as at 31st of December 2022. So we are given property at costs, and we are told included within that property is a building whose cost is 400,000. We have the plant at cost, motor vehicle at cost, office equipment at cost. We have accumulated depreciation for building, plant, motor vehicle, office equipment. Then we have inventory on 1st January 2022, purchases at cost, distribution cost, administrative expenses, revenue, trade receivables and trade payables, bank balance, deferred tax, current tax, and the bank interest. Then we have the ordinary share capital share premium, retained profit on 1st January 2022, interim dividends which were paid, and then we have the suspense account. Then we have some additional information, number 1, all the way to note number 6. And then what are we required to do? We are required to prepare the foreign financial statement presented in a suitable format for publication. Number 1, we are required to prepare the statement of profit or loss for the year which ended 31st of December 2022. Roman 2, statement of changes in equity for the year which ended 31st of December 2022. And Roman or Part C, we are required to prepare the statement of financial position. So before we prepare what is required here, I want us to go through the additional information. We see whether there are some workings which are required. We do those workings and we finally prepare what the examiner was requiring. So therefore, we will start by having some workings. And this is as per the additional information. So let's go to the additional information number 1. You see what we are told. Additional information number 1, we are told what? What are we told in the additional information number 1? In the additional information number 1, what are we told there? We are told during the year which ended 31st of December 2022, which is automatically the current year, BD Limited disposed of an item of plant for a cash proceeds of 20 million, which has been credited in the revenue account. No other accounting entries was made. The plant had a cost of 39.7 million and accumulated depreciation of 15.86 million. So we are told any gain or loss on disposal of the plant should be included within the cost of sales. And then we are told it is the policy of the company to provide a full year depreciation in the year of the asset purchase and none in the year of disposal. So in that case, we're given information about an asset which was disposed. And there are two, I think, two adjustments we are going to make in relation to that, because we are told that this item of plant was sold for 20 million. Now, this 20 million, we are told, is included within the revenue. So it is obvious that once the company sells an asset, the amount received from the sale of asset, this should not be treated as part of the revenue, should not be treated as part of what? Of the sales. And therefore, this amount of 20 million, which was received from the disposal of the plant, 20 million, this one will be deducted from the revenue. This one will be deducted from the company's what? Revenue, because you are told this 20 million was included within the revenue. It was credited in the revenue account. It's also important for you to note, if you go to the requirement, to the trial balance, it is important for you to note that trial balance which you're given, if you check on the figures up there, you'll be able to see that those figures are in thousands of shillings. So therefore, for us to be consistent, we must work with all our figures in thousands of shillings. In any of the figure we have from the additional information, we must omit the last 3 zeros. We must omit the last 3 zeros. Yes, we must omit the last 3 zeros. The last 3 zeros. Yes, I'm trying to make some changes on my camera here. I don't think it is that clear, but it should be now. It should be now. It should be clear now. Should be clear. Yes, it should be clear. Okay. So therefore, what you have said is that this particular amount, we will deduct it from the revenue. Number 2, anytime the company sells an asset, disposes an asset, you must compute whether the asset was, you must determine whether the asset was sold at a gain or at a loss. And actually, we do that by preparing an account which is called the disposal account. So therefore, what we need to do is basically to prepare the disposal account, and we determine whether this asset was disposed at a gain or at a loss. Although in this case, let's not use the disposal account. Let's not use this account. Let's just compute this directly. To compute the gain, or basically the loss on disposal of an asset, we take the sales proceeds. Our asset was sold at how much? And then we deduct the net book value, which is the same with the carrying amount. We know that the net book value of an asset, this one is equal to the cost minus the accumulated depreciation. So if you get, after taking this minus this, if you get a positive figure is a gain, but if you get a negative figure here, is what? Is a loss. So therefore, let's compute this. We will take the sales proceeds, and basically the sales proceeds is this particular amount at which our asset was sold at, 20 million. And then to that, we proceed and we less the net book value. So the net book value, we are saying, is the cost minus accumulated depreciation. If you check on the information we have in paragraph, in note number 1, sentence 2, we are told no accounting entries was made. The plant had a cost. We are given the cost. I want us to compute this one. We take the cost, which is 39,700,000. That was the cost, and accumulated depreciation of 15,860,000. So this now will give us the net book value. So therefore, we take 20,000 minus this net book value. So how much would be our net book value here? How much would be our net book value? The net book value for this item. So that would be 39,700 minus 15,860. 860. So what are you getting? I'm getting a figure of 23,840. Is that what you're getting? Lucia, Helen, is that what you're getting? Hassan, Virginia, Raphael, is that what you're getting? Yes. So it basically means that this particular asset here was sold then at a loss, because if we take this minus this, we will get negative what? We'll get negative 3840, which basically is a loss on disposal. So being a loss on disposal, this one will be included within the cost of sales. Within the cost of sales, it will be added to the cost of sales. It will be added to the cost of sales. So I think those is what is required. One, we have said this amount of 20 million, which was included within the sale. We will less that from the sales. Also, in this case, we have computed the loss on disposal, which you have said will be added to the cost of sales. So let's move to note number 2. And you're told the depreciation on property, plant, and equipment is to be provided and allocated as follows. So we are given the 4 asset: buildings, plant, motor vehicle, office equipment. We are given the rate for computing the depreciation, the basis of computing the depreciation, and how that depreciation will be classified. So let's compute those particular depreciations for the current year. That should be our working number 2. Depreciation. So we start by computing the depreciation on buildings. Depreciation on buildings. In this case, we are told this will be 2.5%. Using which method? Using the straight line. So you have to recall, under the straight line method, we compute the depreciation based on cost. Under the reducing balance method, we compute depreciation based on the net book value. So therefore, for building, we will take 2.5% of the cost. What is the cost of the buildings? The cost of the buildings, this one, you should get it in the trial balance. The first item within the trial balance, we have property. And property we know comprises of land and building. This is something I said in our previous class. Property comprises of land and building. So in this case, we are told the cost of buildings is 400 million. It automatically means that because the total cost of the property is 600 million, the cost of land is 200 million. But in our case, we're interested with this. We're interested with the cost of the building. So the cost of the building in this case is 400,000. Remember, we are working with all our figures in thousands of shillings. In any figure, we are omitting the last 3 zeros. So let's get 2.5% of that. 2.5% of this will give us what? 2.5% of this. What are you getting? What are you getting here? Are you getting 10,000? Yes, 10,000. That is the figure I'm getting from Helen. That is the figure I'm getting from Lucia. Okay. So then from there, basically, even before we proceed to compute the other depreciation, we are told that this depreciation here of 10,000, this one would be classified as part of the administrative expenses. So let's move and compute the depreciation on plant, which will be 10%. 10%. Which method is used here? The reducing balance method. So under the reducing balance method, we compute depreciation based on the net book value, So we need to compute the net book value of the plant. How do we compute the net book value? So we will take the cost, because this one is equal to the cost minus the accumulated depreciation. So therefore, the net book value of the plant will be equal to the cost. The cost is given in the trial balance. The cost is given in the trial balance. Can you see the cost? The cost is the second item within the trial balance, which is 280,000 minus the accumulated depreciation, which is down there. The accumulated depreciation, who can be able to see the accumulated depreciation on plant? It is 111, 111, 160. 111, 160. 111, 160. 111, 160. 111, 160. So this will give us what? 280,000 minus 111, 160. And what are you getting here? Yes, I'm getting a figure of 168, 840. Is that what you're getting? Is that what you're getting? Please confirm. Hassan, are you getting this? Noor, are you getting this? Is that what you're getting? Is that what you're getting? Is that what you're getting? Please confirm so that we move. Is that what you're getting? Yes. So we have 168, 840, 168, 840. But now you have to remember, in the additional information number 1, there was a plant which was disposed. Can you remember this plant which was disposed? I want us to go back to note number 1. We see what we are told. Specifically, the last sentence of note 1. In the last sentence of note 1, we are told it is the company's policy to provide for the full year depreciation in the year of the asset purchase. What does that mean? It basically means that once the company has purchased an asset in a given year, the company will provide a full year depreciation. Even if the asset is bought 2 months, 1 month, or even 3 months to the end of the year, the company provides a full year depreciation. That's what you're told. And none in the year of disposal. And none in the year of disposal. So if an asset is purchased in course of the year, no depreciation for that asset. And therefore, I hope you can be able to recall, during the current financial year, the company disposed this plant. And we are told, whenever an asset has been disposed in a year, no depreciation to be provided in that year. So this net book value here comprises the net book value of this plant which was disposed. So what we need to do, before we compute the depreciation, we need to eliminate the net book value of this plant which was disposed. The net book value of this plant which was disposed is basically what we have computed here. Remember the net book value. This is the net book value of the plant which was disposed. So therefore, we left it here. We left 23,840. So why are we doing that? Because as per note number 1, the last sentence, we are told, no depreciation in the year of the asset disposal. So if an asset is disposed in course of a certain year, no depreciation to be provided in that year. Sasa? Yes. So this now will give us what? We take this one minus this, minus 23,840, which will give us 145,000, and then we get 10% of that. So 10% of that will give us what? Will give us 14,500. And then this depreciation here then will be classified as part of the cost of sales. Will be classified as part of the cost of sales. Will be classified as part of the cost of sales. Will be classified as part of the cost of sales. Is that point clear? Have we understood where we have done that? Zipporah? Noor? Is that point clear? Is that point well understood? If it is well understood, let's move and compute the depreciation for the other asset. So we are still in note number 2. Let's compute the depreciation on motor vehicles. Motor vehicles, which is equal to 20% of what? 20% on street train. Street train, we compute the depreciation based on the cost. What is the cost of motor vehicles? Motor vehicles, basically, this is that item within the trial balance, which is 70,000, and this will give us 14,000. So how should this depreciation be classified? As per note number 2, this one will be considered as part of the distribution costs. So we also compute the depreciation as per note number 2 on office equipment, which will be 12.5%. 12.5% of the costs, because the method to be used there is the street train. So the office equipment, the cost for that is 40,000. 40,000, 40,000. So what would be 12.5% of this? 12.5% of this. This will give us what? Is it 5,000? 5,000. Yes, 5,000. And basically this one still will be part of the administrative expenses, part of the administrative expenses. So we are done with that point. We are done with that point. I want us now we move to point number 3. In point number 3, we are told it is discovered that the former financial controller of BD Limited engaged in fraudulent financial reporting of shillings 12 million of the trade receivables. Okay, let's take that point again. We are told it has been discovered that the former financial controller of BD Limited engaged in fraudulent financial reporting. Shillings 12 million of the trade receivables are non-existent and need to be written off. Of this amount, 7 million relates to the year which ended 31st of December 2022, which is now the current year, while the balance or with the balance relating to the prior period. So basically, we are told in that point, the former financial controller of this company was involved in fraudulent financial reporting. Fraudulent financial reporting, in very simple terms, we refer to this as cooking the books of account. If, for example, as an accountant, you want to show the company is financially stable, you may overstate the assets. You may overstate the asset, or basically you can overstate the revenue. So that's what the financial controller did. So within the trade receivables, he included 12 million, which is non-existent. So no debtors who owe the company an amount of 12 million. And we are told this amount has to be written off. That amount has to be written off. So the working 3 here will be the trade receivables. The trade receivables, which are to be written off. So the trade receivables to be written off basically is an amount of 12 million. So we are told 7 million of these related to the current year. And basically this one will be treated as an expense, will be recognized as an expense within the current year. Remember, what we said is that when preparing a statement of profit or loss for publication purpose, we classify the expenses into 5. Now, this particular amount which was written off, we have to determine it will be classified as part of which expenses. Is it part of the cost of sales? Is it part of the distribution, admin, finance, or other expenses? Now, because this particular amount has been written off as a result of a decision made by the management of the company, this one we included within the administrative expenses. It is an amount which has been written off as a result of administrative decision, as a result of decision made by the management. So this one will be added within the administrative expenses. And then the other amount, which is 5,000, which relate to the previous year, this one will be adjusted in the retained earnings, when preparing the statement of changes in equity. Statement of changes in what? In equity. If you can be able to recall in our previous class, I gave you the format for preparing this statement of changes in equity. We said any prior year adjustment. These are adjustments which were supposed to be done in the previous year, but they were not done. They should be adjusted to the retained earnings at the start. Because this was this amount of 5 million was supposed to be recognized or was supposed to be accounted for by the company as an expense in the previous year, but it was not accounted for. So this one we will deduct it from the retained earnings of the company at the start. This one we treat it as an administrative expense, and then the full amount, this one of 12, this one automatically will be deducted from the trade receivables. The trade receivables of the company will be reduced with what? Will be reduced with the 12 million. So that is the adjustment which is required for that amount. So let's move to the other note. Let's move to the other note. We move to the other note, we see what we are told. Note number 4. Note number 4 is all about IAS 12, income taxes. And we are told the existing debit balance on the current tax in the trial balance represent other stroke over provision for previous year's tax. Can we first of all go back to the trial balance? In the trial balance, I can see we have something called the current tax. Can you see the current tax? And actually, we are told that that current tax is a debit balance. So how much is the current tax in the trial balance? The current tax in the trial balance is how much? Current tax in the trial balance. Current tax in the trial balance, can you see that? Current tax in the trial balance. Yes, so I'm told that current tax in the trial balance is an amount of 2,600. 2,600. Now, take into account this amount in the trial balance, it appears on the debit column. What is this? Is it over or under provision? What is this? Based on our previous discussion, is it under or over provision of tax? Over or under? I'm told by Zipporah it is under, by Lucia it is under. Yes, automatically this one is under provision. Is under provision. We said if that amount appear on the debit column of the trial balance, it is under provision. If it is appearing on the credit side, we say this what is over provision. We say tax under provision in the previous year should be brought to the current financial year and should be added to the current year's estimated tax liability. So in the other sentence of note number 4, we are told a provision for current tax for the year which ended 31st of December 2022 over 52 million is required together with a decrease in deferred tax provision of 3 million. So basically what we need to do here is, first of all, we compute the amount of current tax, which will be taken to the income statement. And we say to compute this one, we take the estimated tax liability for the current year, which you're told is 52 million. And then we adjust this with the over or under provision of current tax from the previous year. Remember, in the previous year, there was under provision, which we should add to this. So to this, we should add what? 26. And basically now that will give us what? That will give us a total amount of 54,600. So this is basically what we will recognize in the income statement or in the statement of profit or loss as the current tax. Still in the same point, we are told there was a decrease in deferred tax provision. There was a decrease in the deferred tax provision of 3 million. So how do we account for this? A decrease in deferred tax. How do we account for this? Who can be able to recall? Because what we said is that during the current year, what we account for in the income statement as far as the deferred tax is concerned is the increase or the decrease in deferred tax liability. So we are told there is a decrease in the deferred tax liability. So we say this one should be accounted for as what? In the income statement. Who can be able to recall? Zipporah, we said this one should be recognized as what? In the income statement. Remember the other question which we did, we had an increase in deferred tax liability. We accounted for that as a deferred tax. Actually, we had a decrease. I can remember. We had a decrease and we accounted for that as a deferred tax income. So the same case, because there's a decrease in deferred tax liability, this one in the income statement, will be recognized there as a deferred tax income. So we are done with that. Let's move to the other point. Number 5, we are told the inventory count as at 31st of December 2022 revealed the value of the inventory at cost was 85 million. So this is the closing inventory, no working which is required. In note number 6, we are told on 30th of December 2022, the company directors invited the current shareholders to subscribe for a right issue on the basis of 1 share for every 5 shares which were held at an exercise price of 15. So this is information about the right issue. And then you're told the come right price. The come right price is the market price per share before the right issue. The come right price on the last day of trading was shillings 20. And then you're told the proceeds from the fully subscribed right issue was credited in the suspense account. So basically, in that case, we are told there was a right issue. And I hope you can be able to recall we said a right issue. This is the issue of additional shares to the existing shareholders of the company at a price below the market price. So what we need to do here is we compute how many shares were issued by the company during the right issue. And as per note number 6, we are told during this particular right issue, the company was to issue 1 share for every 5 shares which were held. So the company was to issue 1 share for every 5 shares which were held. So what we need to do is to determine how many shares were held before the right issue. So we take the ordinary share capital of the company. The ordinary share capital that should be around the 4th item or the 5th item from the bottom of the trial balance, which is 200,000. We want to know the shares which had been issued by the company before the right issue. We take the ordinary share capital. For us to be able to determine the shares, we divide that with the par value per share. The par value per share in that case is 10. So this will give us 20,000 shares. So these are the shares which were held before the right issue. So we need to determine how many shares were issued during the right issue, because the company was to issue 1 share for every 5 shares which were held. The shares which were held were 20,000. So we cross multiply, then we divide. So we have 1 times 20,000 divided that with 5. So this will give us the shares which were issued by the company during the right issue. So, and this will give us, is it 4,000 shares? 4,000 shares, is that what you're getting? 4,000 shares. Please confirm whether you're getting that figure. Is that what you're getting? 4,000 shares? Yes, 4,000 shares. And as per note number 6, these shares we are told they were issued at a price of what? They were issued at a price of 15. Remember, during the right issue, the shares are always issued at a price below the market price. So the amount which was raised from the right issue was 4,000 times this, which was 60,000. And we are told in note number 6, this amount was credited in the suspense. You see, anytime the company has issued share, the amount which is received, that amount is always debited in the bank account. This amount is debited in the bank account, and basically should be credited in the ordinary share capital. Part of it should be credited in the share premium. I'll be able to explain what we credit here, what we credit here. A total amount of what? Of 60. But instead of the company crediting this to account, the company credited the suspense account. And that's why in the trial balance, the last item, I hope you can see a suspense account, and the amount credited there was 60. So that this amount of 60 was credited here instead of being credited in the share capital and the share what? Premium. So we need to do the correct accounting entry, or to effect the correct accounting entry. And this amount of 60,000, we are saying it was supposed to be credited in 2 accounts: ordinary share capital and the share premium. Now, the amount which we credit in this account is always based on the par value per share. So we take the shares which were issued, which were 4,000, and then we know the shares were issued at 15. The amount which we credit in this account is always based on this amount here, the par value, not the issue price, but the par value, the amount which we have in the trial balance, the par value of 10. So the amount which is credited in the share capital is always based on the par. So therefore, the amount which was supposed to be credited in that account is 40,000. The amount which was supposed to be credited in this account, or the amount you are going to credit in this account, is equal to the shares which were issued times the amount of the share premium. The amount of the share premium is basically the amount which is above this 10 shillings. Remember, the shares were issued at a price of 15. How much is the amount is above 10? The amount above 10 is 5. So that one is a share premium. So an amount of how much? An amount of 20. So therefore, in preparing our statement of changes in equity, This will be added to the share capital. This one will be added to the share what? To the share premium. To the share what? Premium. And basically in our case, I think we are done. So what we need to do now is basically proceed and prepare what is required. So we start with part A. So we have the title. The name of the company is BD Limited. And this is the statement of profit or loss. Statement of profit or loss, which is for the year, which ended 31st of December 2022. 31st of December 2022. 31st of December 2022. So here we need to have just a single column like that. We just need to have a single column. So have this so that we move together. Yes, so I want us we prepare this together. I hope you already have the title with you. I hope you already have the title with you. And what do we start with here? Who can be able to remind us? Zipporah, what do we start with here? In preparing the statement of profit or loss, we start with what? We start with what? We start with the revenue. We start with the revenue. So the revenue, that one is always given in the trial balance. That one is given within the trial balance, So revenue, how much is the revenue? You have to recall the revenue will have to be adjusted because this amount which was received from the sale of the asset was included within the revenue. So once the company sell an asset, that is not considered as part of the sales. So the revenue I'm told here is an amount of how much? Is an amount of 1123,500. 1123,500. So to this we less this amount of 20,000, which was included within the revenue. And this will give us an amount of how much? This will give us 11,03,500. 11,03,500. Is that what you're getting? Is that what you're getting? If yes, please confirm. Please confirm. Are you getting that? Yes. So having that, we need to move and we compute the cost of sales. You have to recall, how do we compute the cost of sales? Cost of sales, this one is equal to opening inventory plus purchases minus closing inventory plus depreciations plus the loss on disposal. Because in our case, we are not given the cost of our sales. We have to compute that. So this cost of sales, we go back to the trial balance, and below the accumulated depreciations, we have the opening inventory. So the opening inventory is an amount of 138,000. To that we add purchases. Purchases is below that opening inventory, which is an amount of 667,000. 667,000. And then to that we less the closing inventory. I hope you can remember closing inventory is in note number 5. Note number 5. So we less 85,000. We less 85,000. And then to this we add various depreciations. So from these depreciations which you have computed in working 2, some depreciation should be included as part of the cost of sales. One of it is this depreciation on plant, which is 14,500. Do we have any other? This part of admin, this part of distribution, this part of admin. Yes. So no any other depreciation. And then finally, we add the loss on disposal. I hope you can remember, here we have a loss on disposal, which we said will be included as part of the cost of sales, this one. So we add 38,40. So that is how we compute the cost of sales, which we take to the last column, which we take to the last column. So this will give us what? 138,000 plus 67,000 minus 85,000 plus 14,500 plus 3840. And I'm getting a figure of what here? I'm getting a figure of 738, 340. 340. Are you getting that? If yes, please confirm. Yes, so that is confirmed by Zipporah. Are you getting the same? Are you getting the same? Helen, Lucia, Raphael, are you getting the same? So if you're getting the same, we need to move and we compute the gross profit. The gross profit. The gross profit should be the difference between those two values. Give me the gross profit. How much is the gross profit? The gross profit I'm getting 365. One what? 160. 365, 160. So to this then we proceed. Please confirm whether you're getting those figures. Are you getting those figures? Are you getting those figures? Yes. So then to this we proceed, we add other incomes. Remember, we say that when checking for the other incomes within the trial balance, we check the items appearing on the credit side. So in the trial balance on the credit side, which incomes do we have? So I think on the credit side, I can see accumulated depreciations. Those are not incomes. Down there, I can see revenue, trade payables, bank balance, deferred tax, and the bank balance. And then on the other side, I can see share capital, share premium, retained profit, and suspense. So in that case, we don't have any other income. We don't have any other income. So to this, then we proceed. And we less now the expenses. Maybe first of all, you can get the total incomes, 365, 160. So we less the expenses. Remember, this is our total incomes. So for the expenses, we can start with the distribution cost. The distribution cost. The distribution cost, we take the amount given in the trial balance. And the distribution cost is given below the purchases. I hope you can see that. Which is an amount of 44,000. That is the distribution cost, which is given within the trial balance. Given within the trial balance. Given within the trial balance. And I hope my video is good. Or is it fluctuating? I can see some information on my screen that my internet may not be stable. Helen, Raphael, Zipporah, is my video clear from your side? Is my video clear from your side? Okay, so if it is clear, then let's continue. So now to this distribution, we need to add certain depreciations. So like this depreciation on motor vehicle will be included here. Will be included there. Then this one is admin, this one is admin. Okay, so we get the final figure, which is 58,000. 58,000. Then from there we proceed and we take into account the administrative expenses. So the administrative expenses, we take the amount given in the trial balance, which is below distribution cost, and that is that 93,500. So to this, we first of all include this depreciation on buildings, 10,000. The depreciation on office equipment, 5,000. 5,000. And then there is something else to be included here, and that is this amount of 7,000, the trade receivables which were written off. So we also add 7,000. 7,000. I don't think we have any other adjustments. So then we get the final figure. We get the final figure. We get the final figure. So we have 93,500 plus 10,000 plus 12,000. Plus 12,000. I'm getting a figure of 115,500. 115,500. 115,500. 115,500. Is that what you're getting? 115,500. Yes, that is confirmed by Zipporah. That is confirmed by Zipporah there. So then from there, we need to record the other expense, which is basically the finance cost. Now, for the finance costs here, I think what we have is the bank interest. Just like the other question which we did, we have the bank interest. And that bank interest, we said we consider it here as part of the finance cost. And that is an amount of 2,400. 2,400. Then from there, we will proceed and we check whether we have any other expense. We check whether we have any other expense which is not included within the cost of sales within distribution, admin, or finance cost. Maybe we can check that from the trial balance. Remember, you said all expenses in the trial balance, they have a debit balance. So let's check the items in the trial balance or appearing on the debit column. So up there, we have property, plant, motor vehicle, office equipment. All those are assets. Down there, I can see we have inventory, purchases, distribution, admin. We have dealt with those. Down there, I can see we have receivables, current tax, bank interest, and then interim dividends. So basically, none of those are the expenses. And then from the workings which we have done here, we have dealt with this. We have dealt with all these depreciations. We have dealt with this. This income tax will be adjusted to the profit before tax. These are a right issue. It basically means that in our case, we don't have any other expense. We don't have any other expense. So what we need to do now is we get the profit before tax. We get the profit before tax, basically by taking the total incomes minus those three expenses. Minus those three expenses. So 365,160 minus 58,000 minus 115,500 minus 2,400. Yes, what are you getting here? What are you getting here? I'm given a 62 to 60 by Lucia. Lucia, is that correct? 189 to 60. 189 to 60. 189 to 60. That is the same amount I'm getting there. Lucia, please confirm your figure. Yes, now to this we proceed and we make adjustment for income tax expense. Income tax expense. Now remember, you say that this income tax expense, this one basically comprises of two values or two components of taxes. Two components of taxes. It comprises of the current tax, which we computed here, and the deferred tax. So let's first of all we consider this one. the current tax, and the current tax is this amount which we computed here, this one, which is 50,4,600. And then also this one comprises of the deferred tax. And what we have here is the deferred tax income. So the deferred tax income, that one should be added here. And it's basically an amount of 3,000. So because it's an income, we add it to our profit. We add it to the profit here, and basically we get the profit for the year. The profit for the year, or basically the profit after tax. The profit for the year or the profit after tax. Yes, so that will be how much? Minus 54,600 plus 3,000. Plus 3,000. That is coming to 137,660. 660. That is what I'm getting, yes. So then to this, we said we proceed and we add the other comprehensive incomes. Other comprehensive incomes. These other comprehensive incomes include the gain or loss, the revaluation gain or loss on things like PP. If you check on this question here, we don't have any revaluation gain or loss on what? PP. So meaning that the total comprehensive incomes remain 137, 660. Remains 137, 660. So that's what was required in part A of that question, and the marks which were allocated there were 6. So these are basically the items which will give you those 6 marks. So that and that, the expenses, our 3 expenses, basically the tax like that. So let's move to part B, and we are required to prepare the statement of changes in equity. The statement of changes in equity. So remember, a statement of changes in equity, this one is prepared basically to show the changes in the various items of equity. And therefore, we said in preparing this statement of changes in equity, we always start with the details column. And then we need to go back to the trial balance which are given. We see which items of equity was this company having in this year. So we have various items of equity. Actually, we said equity comprises of share capital and reserves. So the first item of equity, I can see ordinary share capital. Below ordinary share capital, I can see share premium. Maybe you can just write that in full. And then from there, we have the retained profit. The retained profit. Do we have any other component of equity? Any other component of equity? I don't think so. And then finally, we have the total column. It's also important for us to indicate here that our figures will be in thousands of shillings. So what do we start with here? We always start with the opening balances. We start with the balances brought down. The balances brought down, these are the balances we have in the trial balance. 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 Someone is saying my Mwalimu's board is not clear. Is my board clear? So please confirm that as we continue. So we record the opening balances. So for the share capital, this is 200,000. Share premium is 50,000. Retained earnings is 223. 640. 640. Yes. I think the internet, I think it is fluctuating. I don't know what is happening, but I don't think it is that bad. So let's get the totals. We have 250 plus 223, 640. 640, which will give us 473, 640. 473, 640. Then what do we need to do? We need to record the various items or the various transactions which occurred during the current year, and basically which affect these items of equity. Maybe you can start with what? Let's start with what we have here. This statement of profit or loss which I have prepared. We said what we bring here is the profit after tax. The profit after tax, this one, or the profit for the year. And actually that one should be taken to this column, the retained profit or the retained earnings column. And then we take it to the last column, 137, 660. Then from there, we have this right issue. And basically the right issue, we have said it will affect 2 items. We're going to add 40,000 to the ordinary share capital, 40,000, and then to the share premium, we add 20 there. The total amount is 60. We take it to the last column there. We take it to the last column there, Okay, so then from there, this will not affect that. We have this particular amount here of 5,000, which we said will be deducted from the retained earnings at the start. And actually this one, we refer to it as the prior year adjustment. The prior year adjustment. This was an item which was supposed to be adjusted in the financial statement for the previous year, but it was not adjusted. So this one will be deducted from this, because this was supposed to be, or this 5,000 was supposed to be recognized as an expense in the previous year, but it was not accounted for. So the profit of the previous year was overstated. So that's why we are deducting that from the retained profit from the previous year. Sasa? Yes. So we refer to it as the prior year adjustment. So let's check whether we have any other adjustment we need to capture there. This one will not affect that. The same case with this, but if we go back to the trial balance, I think there is somewhere I saw interim dividends. Yes, we have interim dividends. The second item from the bottom of the trial balance, we have interim dividends. Interim dividends. Interim dividends, we said dividends are always paid from the profit. So we left those dividends here, which is an amount of 10,000, and we take it to the last column. We take it to the last column. So I don't think we have anything else. So let's get now the balances at the end of the year, which then we transfer to our statement of financial position. So ordinary share capital, this will be 240,000. 240, this one will be 70,000. So we need to get the closing balance in the retained earnings or the retained profit, 223,640 plus 137, 660 minus 15,000. So what are you getting here? I'm getting 346,300. So then we need to get, is that what you're getting? Yes, that is confirmed. So let's get the total in the last column. The total in the last column, you may decide to add this plus this plus this, or you work out that downward. You should get the same value. You should get the same value. I'm getting 656,300. 656,300. Okay, yes. So that is it. That what was required in that question, and equally the marks allocated there were for those. These are basically the items which are marked: the opening balances, profit after tax, the right issue, interim dividend, and the prior year adjustment. Remember, the totals are not marked here. These totals are not marked. The same case with those totals. So we go to part C, where we are required to prepare the statement of financial position, a statement of financial position, statement of financial position. So here we start by recording the non-current assets. We start by recording the non-current assets, non-current assets. So for the non-current asset, remember, we always start by recording the tangible non-current asset. Tangible non-current asset in our question here, we basically have a number of them, including property, plant, motor vehicle, office equipment. But in this case, if you can be able to recall, we said when preparing a statement of financial position for publication purpose, we don't record those particular assets yet separately. So instead, compute the total net book value and basically include them here under the name of the property, plant, and equipment. So that's basically what we need to do. So here we will have the property, plant, and basically what? Equipment. So we will start with the first asset within the trial balance, The first asset within the trial balance is property. So property comprises of land and buildings. So we will take the cost, which is 600,000. First of all, I will deduct. Remember, we say that to compute the net book value of an asset at the end, you take its cost at the start minus the accumulated depreciation, which is in the trial balance. The accumulated depreciation in the trial balance, this is the accumulated depreciation at the start. And because you are not interested with the net book value at the start, to this also we have to less the depreciation for the current year. The depreciation for the current year is what we computed in working two. In working what? To depreciation for the current what? Year. Yes. So to this, we will less the accumulated depreciation at the start. Remember, this is the property which comprises of land and buildings. The accumulated depreciation at the start in the trial balance is 80. And then we also less the depreciation for the current year, which is this one, 10,000. That is basically for property. That is for what? For property. Then to this, I will add the net book value for plant. And for plant, in this case, we must recall that there was a plant which was disposed. So therefore, in terms of how we are going to compute the net book value for the plant, that one will be quite different. That one will be quite different because this plant which was disposed, do we need to include it here? Who can tell us? The plant which was disposed, should it be included here? Helen, Zipporah, should we include it here? The plant which was disposed, yes or no? Do we include it here? Once an asset is sold, do we include that asset here? Yes or no? Automatically no. So therefore, in terms of how we are going to compute the net book value for plant is quite different. So what we will do, we had computation, that computation here. This amount here, this was the net book value for the plant at the start. But in this case, we proceeded and we deducted the net book value of the plant which was disposed. And in that case, after taking this minus this, I can remember we had a figure of 145,000. So this 145,000 is the net book value of the plant at the start of the year. And that does not include the net book value of the plant which was disposed. So therefore, to compute the net book value of the plant at the end, I will take 145. This is the net book value of the plant at the start, excluding the plant which was disposed. And then because this is the net book value at the start, this amount of 145, I will have to less the depreciation for the current year only. The depreciation for the current year only for plant is how much? Is 14,500. So to this, I will less 14,500. So remember this now for plant. This for plant. This for plant. You can see the computation for that is quite different because of the plant which was disposed. Then let's move and compute the net book value for the other asset, which is motor vehicles. So to this, we will add motor vehicles. We need to compute the net book value for motor vehicles. The computation would be the same here. We take the cost of motor vehicles at the start, 70,000, minus the accumulated depreciation at the start, which is given in the trial balance, 42,000, minus the depreciation for the current year, this one, 14,000. So this is how we compute the net book value for motor vehicles at the end. So to this, we add the net book value for office equipment. For office equipment, I'll do the same. I'll take the cost, which is 40,000. I will less the accumulated depreciation at the start in the trial balance, 15,000. I will also less the depreciation for the current year, which is 5,000. Which is 5,000. So this now will give us the net book value for the plant, for the office equipment at the end. And then I'll get the final figure, which will be the net book value for all tangible and current assets. So that will give us what? Maybe we can start with the property. So this 600,000 minus 90. 600,000 minus 90,000. And basically that should give us what? That should give us 510. What about plant? We take 145 minus 14.5, which will give us 130.5. What about motor vehicles? Motor vehicles, we have 70 minus 40 minus 14, I'm getting 16. And then office equipment, I have 40 minus 20. 40 minus 20, which will give us 20. So we add all these net book values. 510 plus 130.5 plus 16 plus 20. And this is the final figure I'm getting, 676,500. So confirm whether that is what you're getting. Confirm whether that is the figure you are getting. Are you getting that figure there? Are you getting that figure? That is confirmed by Helen. Okay. That is the total net book value for all property, plant, and equipment, for all tangible and current assets. Then from there, we need to check, do we have any other non-current assets, things like investment, things like goodwill, things like investment property? I don't think we have any. I don't think we have any. So from there, let's proceed and record the current assets. We proceed and we record the current assets. So for the current asset, we need the trial balance. We check the asset on the debit column. So we have dealt with all those items which are up there. Then downstairs, you can see we have inventory at the start. Remember, you said what we record here is the closing inventory, the inventory at the end. Then below that, we have purchases, distribution, admin. In fact, we have dealt with all those items. But downstairs, you can see we have the trade receivables. The trade receivables amount is 74.5. So someone may ask, which amount is the receivables, which amount is payables? So it is obvious that receivables, trade receivables is an asset. All assets have a debit balance. Trade payables is a liability. It should be the one on the credit side. So, but not to this amount of receivables. Remember, we said that there is this amount of 12 million, which we said should be deducted here. So from to this, we less 12 million. That will give us 62, 5 what? 62,500. Okay, so then below receivables, we have bank balance. It is also important for you to see that that bank balance is on which side of the trial balance? The bank balance. The bank balance is on which side of the trial balance? The debit or the credit? The bank balance. The bank balance is on the credit side. Being on the credit side, this is what? This is a bank overdraft. So being a bank overdraft, it would be a current liability. So then from there, we have deferred tax, current tax, bank interest, ordinary, share premium, retain, interim, suspense. And then in the additional information, I think you have dealt with additional information number 1, 2, 3, 4. But if you go to the additional information number 5, we have the closing inventory. Closing inventory, we recognize it here as a current asset. And that is an amount of 85 million. Yes, note number 6 is about right issue. So meaning that we don't have any other assets. So we get the total assets, the total assets. So we add whatever you have here to the current assets. So, and in this case, I'm getting a figure of 824,000. 824. Confirm whether that is what you're getting. Yes, that is confirmed by Helen. I've not gotten any answer from Raphael. Raphael, are we together? Virginia, are we together? Rusia, tuko pamoja? Yes, so once you get your answer, type it in the chat box so that I know whether we are together or not. Okay, so we move and now record items of equity. And for items of equity, remember, we have these figures here. So where do we get these figures? From this statement of changes in equity. So the first item is ordinary share capital. Ordinary share capital. So the ordinary share capital, this is now what we bring here to 40,000. So then from there we have share premium. Share premium, which is 70,000. share premium 70,000. And then from there, we have the retained profit. We have the retained profit. So the retained profit is 346,300. And then we get the total equity. The total equity, which is 656,300. 656,300. Yes. So that's basically what we have as our total equity. So we need to move and basically record now the liabilities. So for the liabilities, we start with the non-current liabilities. We start with the non-current liabilities. Non-current liabilities. Non-current liabilities. So for the non-current liabilities, remember, we start by, or actually here, the non-current liabilities. We say that this one may take the form of bank loan, may take the form of debentures, may also take the form of what? Of deferred tax. And I think in our case here, we just have one, just like the other question. We don't have bank loan, we don't have debentures, we only have deferred tax. We have the deferred tax. Now, this deferred tax, there is a deferred tax which are given in the trial balance. The deferred tax given in the trial balance is how much? The deferred tax in the trial balance, which is below the bank overdraft. Who can see this figure there? The deferred tax, who can see the figure? The figure is how much for deferred tax? Is 32,400. But it's important to note that that deferred tax is the deferred tax at the start. That was we said even in the other question. But now what you have to recall is the information which are given in note number 4. In note number 4, we were told that during the current year, there was a decrease in deferred tax. So therefore, to compute the deferred tax at the end of the year, we will take the deferred tax at the start, 32,400. And then we are told this reduced during the current year with how much? 3,000. So this one reduced with 3,000. So we deduct 3,000. So this will give us 29,400. So 29,400 is basically the deferred tax at the end of what? Of the year. That is the deferred tax at the end of what? Of the year. We don't record the deferred tax at the start, but basically we record the deferred tax at the end of what? At the end of the year there. So we don't have any other non-current liability. We proceed and finally record what? The current liabilities. The current liabilities. So for the current liabilities, I think we have a number of them, and equally it's also important for you to recall that all liabilities have a credit balance within the trial balance. So we check the items on the credit side. So I can see depreciations down, depreciations. Then I can see revenue. Below revenue, I can see trade payables. I can see trade payables. Trade payables is an amount of 68,800. So and then below that, I can see the bank balance. But in this case, specifically, we can refer to that as a bank overdraft. So in most of the cases, the examiner will not tell you that that is an overdraft. That's why you are told just a bank balance. Majority of the students will come and record that here as an asset. So that's why you can see the examiner has not specified that that is a bank overdraft. But anytime you're given a bank balance on the credit side, that is always a bank overdraft. But if it was on the debit side, automatically is an asset here. So we have that bank balance. Then below that, I can see deferred tax. Basically, I've dealt with that. Then on the credit side still, I can see those items of equity. Ordinary share capital share premium, we have dealt with all those. What about in the additional information? In the additional information, we have dealt with the note number 1, 2, note 3. But now note 4, we have the current tax. The current tax. Remember, you said what we recognize here is the estimated tax liability. Estimated tax liability for the current year before adjusting it with overall under provision. In note number 4, sentence 2, we are told a provision for current tax for the current year was 52. So that is what we recognize here before adjusting it with overall other. So I've not recorded the bank overdraft here. And the bank overdraft is the 15,500. So I think we are done with the note 4, 5, and 6. Yes. So basically we are through. So what we need to do is to get the total equity and liabilities. The total equity and liabilities. 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 Total equity and liabilities, what are you getting? Total equity and liabilities, what are you getting here? Yes, I'm told by Helen it will be the same with the total last, 822,000. 822. So here we got 824. Does it mean it is not balancing? 822,000? $822,000? Is that what you're getting? That's what you're getting? 822? So you have a balance of what? 2,000. The totals are not reconciling. Whatever you have here and here is not reconciling. The amount are not reconciling, yes or no? So this was 824. So what is the difference between this and that? What is the difference? The difference is 2,000. I'm told this figure is wrong for PP. Did you got that figure for 676,500? Is that what you got? 676,500. Is that what is that the figure you got? What is the correct figure there, Raphael, for PP? The correct figure for PP should be what? Yes.
But I also say in taxation, when it comes to examination, is almost 50-50. Calculation and theory is almost 50-50. If calculation is more 6 and this is 44. So be aware of those theory thoroughly. That's why I explained those things at the beginning. So if you're a CAMS student and you're in this class, I will be able to revise questions on CAMS. I think as we finish this topic and I give questions, I will take time to revise. Those that are in ATD, I will take time to revise your question a bit. Those who are in CAMS, I will also take time to revise your questions as you also work, because the concept is the same. That is, the taxation part of it is basically the same. That is for CAMS and ATD students. So I want us to embark on where we had stopped. That is particularly what we call the indirect taxes. That is classification, indirect taxes. Indirect taxes. So basically, when you talk about the indirect taxes, we basically say that for the indirect taxes, the incidence of tax is on one person, and the incidence of tax, which is the burden of tax, is on one person, and the impact of tax, which is the responsibility of paying tax, is on another person. Are we together? Just a recap on what we did basically on the direct taxes. We say that for the direct taxes, the impact and the incidence of tax is on the same person. The incidence and the impact of tax is on the same person. And I'm saying that when you talk about the indirect taxes, the impact of tax is on one person and the incidence of tax is on another person. So this refers to taxes. We say it refers to the taxes, where we say the impact of tax, is on one person. The impact of tax is on one person. And the incidence of tax and the incidence of tax is on another person. And the incidence of tax is on another person. I did explain what we call impact of tax. Impact of tax is basically the relation, the responsibility of paying tax, and the incidence of tax is the burden of tax. Who bears the burden? Together, class. We respond with a yes if we are together. Are we together? If we are together, we respond with a yes. So I give examples. The notes are already there. Examples of what you call the indirect taxes. Indirect taxes. Examples of indirect taxes. We basically say includes. We have VAT and import duty, and what you call the import duty, etc. And I want to ask a question to this class. I want to ask a question particularly to this class. You see, when you go to buy a commodity, particularly in the supermarket, let's say in the supermarket, who pays the tax? Who pays the tax, particularly when you go to buy a commodity in the supermarket? Who do you think pays the tax? I hope the board is clear. Who pays the tax? Is it the seller who is the supermarket, or is it you, the buyer? It is the consumer who is the buyer. The supermarket is simply an agent of the government to collect the tax altogether. So nobody can live in an economy without paying taxes altogether. Even children are paying taxes. Even children are paying taxes. Even the children basically are paying taxes. Even the children are basically paying taxes. I want us to proceed to what we call the merits. Merits of what we call indirect taxes. What are the advantages or the merits of indirect taxes? So one of the merits is that it has what we call a wide coverage. This tax has what we call we call it a wide coverage. This kind of a tax, we basically call it a wide coverage. What does it mean? Why does it have a wide coverage? It is based on, we understand it's based on expenditure, which we know covers all classes of people, all classes of people, which basically covers what we call the all classes of people. Is the board clear? Somebody to respond to the yes if the board is clear. Is the board clear? Is the board clear? Are you able to see everything in the board? Perfect, if that is clear. So number one, we say that it has a wide coverage. Why does it have a wide coverage? Because it's based on expenditure and therefore cover all classes of people, And number two, we say that this kind of a tax is basically what we call elastic. It is elastic. And when you say elastic, it can be adjusted. We can easily adjust it. It can vary from time to time. It can vary. It basically means it can vary. We say from time to time. From time to time. It can vary from time to time. We basically mean that it can basically vary from time to time as per the needs of the economy. As per what we call the needs of the economy, as per the needs of economy. As per the need of the economy. It can vary from time to time as per the needs of the economy. Then we talk about what we call economical. We look at economical. Why do you say this tax is economical? Why do we say that this tax is basically economical? Allow me to switch off the light so that it's not. This tax is what's called economical. Why do you say it's economical? Like for the VAT, no need for the agents, especially for the VAT, making returns, no need for agents to be there because, example, for VAT, you don't need agents. They'll simply remit these taxes to the government. The next, we can talk about what's called diversity. Diversity are levied on a wide range of goods and services. So these ones are levied. We can talk about levied on what's called wide range. We call it wide range of goods and services. So we say that they have what's called diversity because they're basically levied on what's called a wide range of goods and services. Then we talk about, very importantly, there's less evasion, what we call less evasion when it comes to this tax. Why do you think we have less evasion? Less evasion. Why do you think we have less evasion? We basically have less evasion because we don't charge them. Whoever pays it is not the seller, but basically the consumer. There's basically less evasion. There's less evasion because we understand that whoever pays them is basically who? Is basically the consumer and not the seller. So we can have the last one, what we call social welfare. What we call the social welfare. We call it social welfare. When you talk about social welfare, the social welfare, levied on harmful products, we know that they're levied on what we call harmful products, levied basically on harmful products, like e.g., what we call beer or alcohol and cigarette, on alcohol and cigarettes. So they're levied on those harmful products. And when they're levied, which reduces their consumption, between which we understand reduces what we call their consumption, which reduces what we call their consumption. They're basically levied on this harmful product, and in return, they reduce what we call their consumption. I want us to talk about the merits or disadvantages, what we call the merits to what we call disadvantages. Disadvantages of indirect taxes. Disadvantages of the indirect taxes. What are the disadvantages of indirect taxes? What are the disadvantages of what we call indirect taxes? I've said based on expenditure, which cover all classes of people. I've said based on expenditure. Let me write it in a big way, based on expenditure. Expenditure, which cover, we say all classes of people, which basically cover all classes of people. It is based on expenditure, which we know for sure cover all classes of the people. So we proceed to disadvantages. What are the disadvantages of this kind of taxes? What are the disadvantages of this kind of taxes? One of the first disadvantage is that they are uncertain. Uncertain. They are uncertain. Don't worry, allow the driver to move with you. They are uncertain. Yes, number one is that they're uncertain in terms of collection, because you don't know how much people are going to spend. Since they're based on expenditure, since they are, we say, based on expenditure, since they're based on expenditure, government is what? Is uncertain. Is uncertain on their collection, on revenue collection. Because you don't know how much people are going to spend in terms of, you can have particular months, for example, that where people are spending, but you could also have months that people do not put their money out for that. Then we have what we call regressive. We call it regressive. When you say a tax is regressive, what does it mean? When you say a tax is regressive, Evelyn Mambo, we have Galma, we have Joy. Whenever we say that a tax is regressive, look at VAT. Look at VAT. Whether you're so rich and the other one is so poor, does the rate of VAT change? Does the rate of VAT change? The rate of VAT is the same altogether. The rate of VAT basically is the same. Whether you're a poor person and the other person is a filthy rich, you'll pay the same. But if you look at an economy, for example, who are the majority in the economy? Is it the rich or the poor? Is it the rich or the poor? The majority is the poor. So therefore, at the end of the day, the burden of indirect taxes is heavily on the poor. So we say the rich and the poor, both rich and poor, both what we call the rich and the poor, and what we call the poor, we say pay what we call the same taxes. But the rich and the poor definitely pay the same taxes. When you talk about the rich and the poor, all of them pay the same taxes, and say pay taxes at what we call at equal rate. At equal rate, both rich and the poor, they pay taxes at equal rate. And in so doing, and in so doing, the poor who are the majority, bears a heavy burden, bears what you call a heavy burden. At the end of the day, it's the poor that bears that heavy burden of tax. It's the poor that basically carry that heavy burden. Then you have it what you call uneconomical. Uneconomical. Why would I talk about this being uneconomical? Why would I talk about uneconomical? So we talked about uneconomical, that is the import duty or the custom duty. For VAT, VAT is economical. But when I look at the custom duty, we have officers at the border. Is that true? When you talk about the custom duty, we basically have officers at the border. Is it true? Yes. When you talk about custom duty, are we together? They are uneconomical to collect. They are what you call uneconomical to collect. And you say especially what you call the custom duty. Especially what you call the custom duty. They're basically uneconomical to collect, especially the custom duty. The government must employ officers. They say the government must employ what they call officers at what they call the entry point. At the entry point, the officers must definitely employ officers at the entry point. So therefore, they become uneconomical. So the next is what you call inflation. Inflation can have for they cause inflation. They lead to inflation. These taxes basically lead to what you call inflation. They lead in inflation. So they lead into price hike together. These indirect taxes, if the taxes are heavy, what happens? The sellers basically shoots the prices of commodities. So we say that indirect taxes are included. Indirect taxes, we say, are included in the prices of what you call a commodity, are included in the prices of commodity, and therefore we say, and therefore leading to what you call to inflation, and therefore that leads to what you call inflation. Allow me to set that so that you can see, and therefore leading to inflation. And therefore leading to inflation, and therefore leading to inflation, and therefore leading to what we call inflation together, and therefore leading. If there's an increase in the price of commodities, therefore that leads to inflation. We all understand that inflation is what we call the persistent rise in the prices of commodity. And lastly, as a disadvantage, we say lack of what we call civic consciousness. Lack of what we call civic consciousness. And this question has just been sent presently. When you talk about indirect, this question has been set presently. So lack of civic consciousness. The paid on commodities, and therefore, we say that the public are not aware of them. How many people will tell you that they don't pay tax because they don't even have PIN? They're paid on commodity, and therefore the public are not even aware of them. The public are not even aware they're paying tax. If you ask the majority of the people, do you think they are aware that they're paying tax? Do you think they are aware that they're basically paying tax? If you ask the public, they're not aware. aware. So we say there's lack of what we call civic consciousness, because majority of people are buying commodity and they're not even aware that they're paying tax. So we go to the last classification. We'll say classification by what we call the rate. Classification by rate. Usiwe na haraka haraka. Mwalimu knows what he's doing. We will get to calculation. And I told you those calculations, they will be as simple as they have never been simple to you. Classification by rate. How do we classify? What is rate? What do we mean by rate when we say classification by rate? A minute. tax, that is CGT. So we basically said that when you talk about the CGT, these are taxes on transfer of property. And basically the properties in question was what we call the land and building. The property in question was basically land and what we call building, land and building. That is where we stopped. And you say that CGT, the rate of CGT, that is the capital gain tax, is currently, we say currently, it is 15. It is what we call 15% of what we call of the capital gain. That currently it is 15% of the capital gain. We say that initially these changes were effected. When you talk about these changes were effected on January 2023. These changes were effected in January, that is 2023 altogether. Initially, the capital gain tax was basically 5% of the capital gain Are we together? If we are together, we respond with a yes. Kama tuko pamoja, then we respond with a yes. Perfect. How do you get capital gain? We say that capital gain is equal to what we call transfer value, what we call the transfer value, minus what we call adjusted cost, minus the adjusted, what we call the adjusted cost. So capital gain, we say is the transfer value minus what we call the adjusted cost. Transfer value minus the adjusted cost. Is the camera clear? Is the sound audible? Is the camera clear and is the sound audible? We respond with the yes if the camera is clear and the sound is very audible. Are you able to see the board? Is everything okay? We respond with the yes. Today we do not want anything to get into our way. Is everything okay? Perfect, if everything is okay. Asante. So how do you get transfer value? How do you get the transfer value?